Dear friends, thank you all for choosing to join our conference today. Welcome. We want to thank you all for choosing to join ICC. We, Ariel, Tomer, and I worked hard to bring you the top speakers and the hottest topics to this event. The event will cover nearly every topic and segment regarding this incredible technology in our amazing community. This is a unique opportunity for everyone to have a personal connection with the speakers, and I sincerely recommend you all to pursue it. Every speaker that will join this stage in the coming days will be happy to meet and talk to you all. Now, in the crypto kingdom, not everything always happy and great. These are challenging days to our community. And some might say that winter has came. Rain isn't always fun. People get wet and need to rediscover themselves. But the rain makes the soil ready to accept new seeds and support their roots. It's the best time to build and innovate. In every market cycle, these are the companies that plant the seeds in the winter and bloom in the summer. The innovators in this crowd will become the leaders and fill this stage in the next wave. Cheers for the innovators. I'm happy to hand the mic to my dear partner, Tomer.
This is the time to build. Despite the uncertainty of the market sentiment, it's important to stick to the fundamental facts. We are witnessing a wave of positive development in different fields, such as regulation clarity, widespread adoption of financial institutions. Banks are keen to enter to the space, and some of them already offers their clients to buy and hold Bitcoin. The biggest brands like Nike, Adidas, Twitter, and Instagram are entering the world of Web3. And finally, impressive entrepreneurs build new companies that will create the products and services we all use on top of decentralized technology in a better, fair, and transparent way. We will be able to witness all the fruits of this adoption in the next couple of years. Our goal for this conference is to be a platform for accelerating the building, innovation, and adoption of decentralized technology through the discussion that we all make here. Moving to Ariel.
Our vision is long-term and not going anywhere. Our team is planning on moving into a higher gear in the ICC through more monthly meetups, a big event for developers in September, and another big conference in December. Our team is prepared to move at full steam ahead, so I wish us all to have 3 amazing days full of experience, learning, and creating quality connection. I hope to see you at the event and our next event. We have 3 days full of panels and guests from all over the world. It's time to start enjoying and smiling. The party has officially begun.
All right, so welcome to Crypto Conference Israel, the Israeli Crypto Conference. We have the one and only Alex Mashinsky here, who unfortunately won't be able to join us physically, but he's in the United States right now doing important work that the guys are doing at Celsius. Whoever doesn't know, Celsius is possibly, I think, the biggest crypto lender today in the space, and Alex can tell you a bit more about the amazing things that have been happening in Celsius. So Alex, do you want to maybe present yourself in Celsius for whoever maybe in the crowd doesn't know you and your incredible business?
Sure. And so Celsius is a member organization. We have about 1.8 million users worldwide. You just download a wallet on Apple or Android, put your coins or tokens in it, and they immediately start earning yield. You can also take a loan against it, so you don't have to sell them and pay a lot of taxes. And you can do other things like swap and on-ramps, and we have a credit card coming up next month that you can also earn yield on or earn the rewards, and all of that is done with no fees to the customers. We actually use the collateral or the assets to lend to institutions, and the institutions pay us fee, and we give most of that back to our community. So we do the opposite of what Coinbase and other people do, where they charge you fees and they give it to their shareholders.
Amazing. Thank you very much. We're going to get to possibly Coinbase in a bit as well. So I think that let's kind of first touch, I guess, the biggest questions right now in crypto. We are a bit after the kind of, whole Terra self-imploding. Again, Terra, Luna, whoever doesn't know, a very big project who created their own kind of algorithmic stablecoin and a very big governance token behind that. A lot of people in crypto really involved in that. And then a certain set of events. Some people are saying a lot of Wall Street pressure trying to short squeeze. Some are saying maybe big issues with, I would say, the governance and the way that was built. So what is your take on this? What could we as crypto community learn? What went wrong? Who tried to hurt us? Is it us hurting ourselves? What's going on there?
Well, so first, just because somebody calls themselves a stable coin doesn't mean that they are a stable coin, right? So you have to understand that there are two worlds. There's a world of assets that are backed by fiat or other type of non-volatile assets, and there are coins that are backed by volatile assets, right? So if you're in the case of Terra, the backing of UST was with another coin that was a very high volatility, and that is just a synthetic coin. It's not a stable coin. It's just a synthetic coin, and we've proven that that synthetic coin can depeg very easily, right? Just a little bit of pressure, and it depegged. Even the stable coin themselves do depeg once in a while. The Hong Kong dollar right now is depegged from the dollar. So even countries that issue these, fiat currencies can depeg. Nothing is set in stone, and people just have to be careful and have to understand what is behind the asset, what could be provided or not. And, those are the things that, make the difference between a high value asset, a very reliable asset, and a non-reliable asset. So we don't know yet who caused this run on the bank, but it looks like this was a malicious attack. And obviously somebody just wanted to make money on it, but it's definitely caused a lot of damage to the community and a lot of damage to the industry, because a lot of people are losing trust in the infrastructure, in the systems that we have, and and that's not good for our community.
Perfect, great answer, Alex. Thank you. So you guys have been here for a long time. I think you guys are one of the veterans, and you have a very large, data scope. Now, I'm not asking for exact numbers, but on your end, are you guys seeing this mini crisis, whatever, act differently? Do you see more run to the bank for Celsius users? Are you seeing old-time hodlers keep holding? It's very interesting to see how you guys can look at how do users react to these type of things?
Yeah, so normally we will see, obviously, again, when you have these drawdowns, and we've seen at least 5 or 6 of them in the history of the company. It's not like the first time we've seen a 50-60% drawdown.
It's every year we have a China ban. It's that day of the year. So yeah.
Well, I call it really it's a test, right? The system, basically the system, the community tests itself. It's a stress test. And so what banks go through with their regulators on paper and on spreadsheets, we actually do that in the real world, because the financial system does do the same thing. It does it every 10 or 15 years. So right now, basically the stress test that the entire economy is going through, the recession that's coming, really, we haven't had one of these since 2008. But crypto markets go through that every year, and every year we retest everybody. We retest we stress test counterparty, we stress test leverage, we stress test liabilities, and anyone who's strong survives, and anyone who's not strong gets taken out. So because the market is in a downturn, that's when you see outside players poking at different projects. Like, for example, they're poking at obviously at Terra Luna, and they've done that successfully, but they're also poking at Tether and USDC and other projects, and Make or Die and others, to see if there's vulnerabilities there. So you can say it's bad, and you can say, oh, these people are against us. But if everything is designed properly and everything is working properly, then we come out of this much stronger, right? And we can scale to the next level of growth as an industry, and other players from traditional finance can come and talk to us about this, or move capital, right? They know that the bridge between TradFi and CeFi, or TradFi, CeFi and DeFi, a two-span bridge, is a reliable bridge. So they can move trillions of dollars across, earn yield, issue loans, do all kind of stuff, and take advantage of the situation.
Okay, so you actually talked about something that I want to touch a bit. You talked about the traditional equity markets being volatile, and then the crypto market kind of maybe acting in accordance. Don't you think that we historically thought that that's going to be the different way? Didn't we all perceive that when equity markets is going to crash, then they're going to come and run to our little safe haven? And haven't we maybe fallen to a place because of institutional adoption that we're now pegged to institutional, I would say, equity markets? And how did we get here?
So 2 points on that. First, I think we always go down first. Even gold, when these things happen, gold would go down first because people have to sell whatever they can. If you have a margin call on your Apple stock or on your Tesla stock or some shit stock that you bought, you're not going to think hard about it. You're going to liquidate the most liquid asset, probably things that did not go down 50%, right? So you're going to go to your kind of hard assets and use them.
FIFO, first out, first in, first out. I just got
Yes.
this Bitcoin thing. I'm going to sell it first.
Exactly. So I think Bitcoin, gold, other assets are moving in tandem first, and then they move apart. And we've seen that. The thing is that when Bitcoin or Ethereum moves apart, it goes up 500%, right? It doesn't go up 2%. So if you're looking at a very short period of time, a few months, you will see 1-to-1 correlation with NASDAQ or 1-to-1 correlation with the stock market. But if you zoom out a few years, you will see obviously that these assets outperformed. Again, the S&P. If you chart S&P versus Bitcoin, you will see that the S&P is down 99% against Bitcoin over 10 years, right? So if Bitcoin is their reserve currency, right?
Another question I wanted to ask.
The second part of this is that you have to understand that this is like a chain reaction. So the crypto market is attached to the stock market is attached to the Fed, and the Fed is attaching itself to inflation. So really, you have to look at the inflation and the VIX, right? Those are the two things that matter. If inflation, we just got numbers yesterday, right? 8.3%. We were hoping to see numbers below 8. And I was on several shows in the last week saying, look, if the numbers is number higher than 8, everything will continue to go down. Number lower than 8, we might have a bear market recovery, right? But basically, all these things are like dominoes that are attached. And if dominoes start to fall, all of them fall in tandem. But this is just a buying opportunity, right? You have to wait, you have to be patient, and you have to use some of your dry powder to average into some of these assets with the long-term view of, okay, 10% of my assets are going to be in crypto, for example, and I'm at 7%, so I can buy a little bit more and average in.
So that's very interesting. You talked about 8+% inflation, which that's what talking about in America, and at the same time they want to fight inflation by raising the interest by 0.2 or whatever. Do you think that gap is sustainable, and do you think at one point will people understand that the yields that they have through their dollars in crypto is so big that they'll actually start understanding that they need to move their fiat into stable coins and start seeing yield there? Are we getting to that point where people are going to have that realization?
Well, look, the yields on bonds, the yields on mortgages, the yields on different assets are competing with yields in crypto, right? So So the Fed, when the Fed raises rates, it basically sucks money out of the market, because if you're earning 3 or 4% on your dollars, you're not going to deploy it in real estate and earn 5%, right? The real estate is much more risky investment than putting it in government bonds and earning 4%. So it acts as a speed bump. It acts as a brake on economic activity, because it competes for capital with the rest of the world. So right now you can earn 7% on your stable coins on USDC or USDT in Celsius, and basically you could just take your dollars, move them over, and they earn 7%. And really, we have no competition from the fiat world for that, right? Your banks are paying you less than 1%. So I think raising rates creates more competition, slows down economic activity, takes money that otherwise would go to markets and do good or work, right? You're going to put dollars to work because of inflation. Now, if you can earn that money by just parking it in bonds or high yield bonds, then these dollars are not going to go to work in the stock market or in the real estate or in other segments of the market. So again, this slows down economic activity, it reduces GDP, and that's really what the Fed is trying to do. They're trying to take all of the heat out of the market.
Perfect. So let's talk about another thing. Brian Armstrong, Coinbase's CEO, said in also a public statement by the company that if in the case, first of all, they had the reports, they're very off their profit expectations. And then he left this little remark saying that if and when the company might go under, then all the crypto that their users put in the company might go along with them. That, of course, sent Coinbase's stock immensely down and also sent more unrest in the market. What are your thoughts about that? Is a publicly traded company saying that the crypto of their users is what being used for running costs? What's going on there?
Well, I think they updated their disclosures and their risk parameters, and this is something that I guess the lawyers asked them to put in, and they didn't think there are going to be major consequences, right? So right now people are very nervous and they read every line and they decided that this is the end of the world.
So you believe this is more of a lawyer talk put inside one of the contractor statements and then cherry picked by press and kind of put out there at the right time?
I see it all day long. People on Twitter trying to get followers by publishing a sensation. And unfortunately, again, a lot of reporters don't do any homework. They just jump on it and say, here's a guy with 30 followers who said that the end of the world is coming, okay, great. So the good news is that Coinbase is a public company. Their financials are available. They just reported their quarter. You can see exactly how much cash they have. And again, I don't think this is good for the community or for the crypto industry, where we ourselves, right, the crypto community is piling up on one of our own and beating them with a club on the head. We have enough naysayers and enough people who want to take us down in TradFi, right? They don't need any help from the inside. So the fact that we are fighting internally over things that are irrelevant just hurts the community, hurts confidence. It makes your Bitcoin worth less, because when people read that, they don't just withdraw from Coinbase, they sell it and they go back into fiat. And every person that came from fiat land into crypto land that you lose because they sell their assets and they go back into fiat land is one more person we have to recruit. It's one more person that we have to bring back and convince that we are the good guys. We're here for the long term. We're not just creating projects so we could do a rug pull on you or steal your money. And that's really what Celsius stands for, right? The confidence, the trust that our community has with us, with $18 billion in assets, right? All these things are, things that are, we always act in the best interest of our community. And I urge everybody else who's watching this to think hard before they clobber one of our own to death for something that really doesn't mean anything.
Actually, I think it's a great point. I want to touch that. So I think that you can see that the crypto community itself does have a pretty good form of, I would say, internal regulation or whatever. And again, everyone talked about the ICO boom. There was 1 year of ICOs, and then we kind of moved above that. You see, hacks here and there, but we're here in Israel. We're at the Israel Crypto Conference. If I'll show now on stage the list of Israeli companies that SPAC'd in the past 2 years and how their stock has been doing, a lot of them look like the shittiest of shitcoins out there, but I don't feel there's enough discussion inside, I would say, the traditional startup community about that. But we in crypto are very, very fast to call out on the naysayers in our own industry and kind of have that discussion. So what is your thought about that? Do you think that maybe the traditional startup equities market, especially the last 2 years of SPACs and IPOs, haven't been getting the hard rep or the scrutiny that sometimes crypto does, especially I would say in the Israeli publics and discussion and media sphere?
Well, many of these SPACs are down 80%, just like many crypto assets. So you can basically say that they have the same quality, right? Or their ability to withstand the winds of time are about the same. So I think, again, we had a lot of euphoria. We had easy money. People thought that you could just flip one thing to the next and it will last forever. But I've mentioned this in January and February that you can't really, you shouldn't be fighting the Fed. If you're standing in the way and you're fighting the Fed, they're going to crush you. They have unlimited resources. They have unlimited capital. They create their own capital, and it happens to be the reserve currency of the world. So I think when the Fed decides to put the brakes on, they're going to be a flight to quality. There's going to be migration from risk assets to safety assets. And you're seeing that already. You're seeing trillions of dollars leaving risk assets and migrating to things that pay yield or pay reliable dividends or have reliable cash flows, right? Your electrical utility is not gonna stop charging its customers or collecting revenues or making profits because Bitcoin is 60,000 or 30,000, or Tesla is 1,200 or $120.
All right, so we're getting up closer to the last part of our talk. What is, if you could have like one message you want to get to the crowd right now, and again, a lot of people have been in crypto for years, a lot of them have discovered it recently, and maybe this is their first little, I would say, downturn. What's a piece of advice that you could give someone who's loved crypto, looked really, really fun into it, and then saw something that he thought was really cool kind of go down 60% in 1 day or 2 days and doesn't know how to feel that? And this isn't his third or fourth or fifth one of those. What's a piece of advice you could give someone like that?
So first, zoom out, right? First, you have to look at the picture over several years, not just the last few days, and think that the end of the world is coming. Yes, there's going to be a hard time ahead of us, but the great companies are always born or always made better during downturns. And I think, we are here to build the future of finance. We're not here to do a quick flip or print something and then dump it on the community or anything like that, right? So if you're building the future of finance, remember Amazon. Amazon was at $108, I think, in 2000, and then it was trading at $8 just a year later, right? And today, or a few months ago, it was one of the most valuable companies in the world, right? So great companies don't change. They're still great companies. They just sometimes trade 90% down. But that doesn't change their business, doesn't change their commitment to build the future and so on. And if you look at AWS, or you look at the same day delivery that Amazon gives you, imagine the world without those services. So crypto is that. Crypto is all of that just for finance. And all of us are working on this. Now we have 900 people, almost 900 people at Celsius, and we're looking to hire more. So all of us are searching for the best talent to come and build those bridges that I was talking about, the bridge between TradFi and CeFi and CeFi and DeFi, and really enable the movement of capital in both directions. It's not that money just moves into DeFi. Sometimes it also needs to go back. And the people that builds roads and bridges are going to do very well. We at Celsius, we don't have our own blockchain. We're not trying to create yet another blockchain to compete with the 200 blockchains that already exist out there. We just want to build roads and bridges between all the different services, and our family of companies, GK8, Celsius X, and several other companies that we have are all parts and pieces of this puzzle to enable reliable transportation of these assets between all the different crypto and TradFi communities.
All right, perfect. So I think there's no better way than finishing this off. So thank you, Alex Mashinsky, one of the bigger players, I think, in Israeli crypto. The title, I think that headline I can get out of this is business as usual. We're growing, we're hiring, do your own research, but macro up and take a zoom out and don't pressure sell. And I think that's a very, very big thing. If it's down 60, 70%, maybe just walk away from the computer, go on with your day, wait for a different day.
Huddle, 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 הכול יהיה בסדר.
Thank you very much, Alex.
Hello, everyone. I am Michelle. I am the Global Marketing Director from Deepcoin Exchange. We have about 1 million users in Asia, and we are ranked in the top 35 on CoinMarketCap. So today I'm going to be talking about the evolution of crypto exchanges, mostly from the aspect of the centralized exchanges, how they started, some of the tumultuous history, and of course, how they've evolved, why they're necessary for the market. Also, I'll talk a bit about what it takes to build an exchange from a tech perspective, and then some of the things that we have learned about our users that engage in derivatives trading on how to improve investment outcomes. So of course, the first recorded Bitcoin transaction took place on October 5th, 2009, here where you can see Satoshi sent Bitcoin through New Liberty Standard and PayPal. Of course, at the time, there was no way to properly value Bitcoin. So New Liberty Standard calculated this exchange rate using a formula based on dividing $1 by the average amount of electricity required to run a computer, yada, yada, 1,100 kilowatts, yada, 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 all this stuff regarding to, Bitcoins generated by a computer over the past 30 days. As you can see, this Bitcoin price in the early days was determined not by buying and selling activity of the Bitcoins, but by the price of electricity and the site owner's personal Bitcoin mining output. Interestingly, it was New Standard Liberty who came up with the Bitcoin symbol B from the Thai baht and the Bitcoin ticker BTC in 2010 on an announcement on bitcointalk.org. This very popular website was responsible for facilitating most of the P2P transactions at the time, mostly using PayPal. By mid-2010, Bitcoin had reached the price of $1 and interest, and Bitcoin grew and new methods for obtaining it emerged. Bitcoin core developer Gavin Andresen created a Bitcoin faucet, a website that would give anyone with a Bitcoin address 5 Bitcoin for free. Very cool. It was at this time that the first Bitcoin exchange emerged. Bitcoin Market was announced by DW Dollar on Bitcoin Talk, and it launched the same year, offering a floating exchange rate for Bitcoin. Buyers could purchase Bitcoin by sending another user US dollars via PayPal, while the Bitcoin market would then hold the seller's Bitcoin in escrow until the seller received their money. So this is a start of an exchange helping to set up pricing based on supply and demand. Great. So now you can see with this nifty timeline here, the ecosystem is really starting to develop. By 2014, exchanges like Mt. Gox and BitInstant were making waves. The first derivatives exchange, ICBit, was released with also one broker shortly following after, and Bitcoin really started to become a true financial product. So as popularity rose, some of the more established exchanges started popping up in 2012, the ones we know today like Coinbase, Kraken, Bitstamp, and then a lot of innovation also came out of the Asian market in 2013 and 14 with Huobi, OKX, Bitfinex. And during this time, the biggest exchange, managing about 70% of the market transactions, was Mt. Gox, now infamous for filing for bankruptcy after hacks in which they lost over 850,000 Bitcoin over the course of several years. Crazy. These momentous hacks have certainly not been the last, and every exchange has had to adopt new and more secure ways to protect themselves from attacks. Every attack is a learning opportunity. And usually with CeFi exchanges, they have learned from Mt. Gox's failures and have the reserve capital to ensure that funds are protected or reimbursed in such an event. Now, continuing on the timeline, we've got a big event that happens 6 years ago this May in 2016. We get perpetual swaps, right? And they take over the derivatives game. And by 2018, we've got new kids on the blocks, Binance, Crypto.com, Deepcoin. And, during these, the years following 2018 to 2020, there's a lot of growth in the market. Wasn't necessarily a friendly one. There's a lot of volatility still. We call this the PVP, players versus players market. Then, of course, the March 2020 crash due to COVID created more uncertainty and fear in the market. And exchanges were forced to deal with more regulatory requirements. But despite all of these challenges, they were continuing to grow their user base and grow the ecosystem. Now in late 2020, we've got the launch of DeFi and NFTs, and that's been a huge shift in how exchanges behave and serve the needs of customers. Of course, DEXs are great for people who want to control over their assets. After the huge rise in 2021 of Bitcoin, hitting 66,000, 67,000, we're probably in another bear market here, especially these last few weeks have been kind of rough, but exchanges are holding on and keeping their customers happy and innovating. Over the last decade, centralized exchanges have evolved from unregulated platforms to regulated, secure, and trusted entities that are the backbone of the digital asset ecosystem. Who agrees? Yeah. Okay. So what does a crypto exchange do, especially specifically a centralized exchange do, right? They facilitate and help secure transactions, manage the order book, right? They provide volume and liquidity to the market, leverage trading, helping minimize the volatility. They can help set prices around the world, right? But I think there's really three important ones that we need to think about. Number one, they provide a low entry barrier to crypto. Basically, anybody that has fiat currency can go to an exchange, sign up, get a wallet, and start buying and trading different crypto assets. And unexperienced traders need somewhere to start and learn about the industry, and adopt it. Number two, benchmarking prices all over the world for new coins. We're managing the order book and volatility. It's very important for the ecosystem. And number three, of course, compliance and security. With regulated KYC marketplaces, transactions are more secure, and you don't have to worry about losing your private key or hardware wallet and then losing all their assets. The exchanges will help manage that for you. Great. And for a second here, I just want to compare and contrast cryptocurrencies to traditional securities. Today, we have a lot of companies that provide both of these services like eToro or Robinhood. And of course, centralized crypto exchanges take a lot of the same principles and learning from their big brothers in traditional securities. But there are a lot of differences in this Web3 landscape and dealing with digital assets that affect how you build and manage an exchange, right? Crypto is still relatively kind of new. It's still kind of a wild, wild west frontier. Regulations are still being developed. Countries don't necessarily know how to deal with them. So everywhere is different, and exchanges have to adapt. Getting listed to something like the stock exchange or NASDAQ, right? This is a more complex compliance process. That crypto just doesn't have, right? Coins are can come in. Validity of them is more of a popularity contest. Maybe, we've got Shiba and Dogecoin that might not have a lot of utility, but have a lot of popularity, which keeps them afloat, stuff like that, that we're still developing. So those are things we need to take into consideration. Also, the crypto market is, of course, open 24/7. This causes a lot more laborious maintenance and scaling needs for an exchange. Also, crypto is a global market instead of the NASDAQ or stock exchanges being more localized. So this is going to impose more risks from a security standpoint. Past 5 years, a lot of projects have come and gone kind of fraudulently. There's been a lot of pump and dump schemes. So, this leads to more volatility in the market, which exchanges need to manage and create insurance funds for, especially when leverage is in play. And as you can see in this graph here, BTC perpetual swaps have dominated the market, overtaking CME futures in 2019. So there's a lot more interest, it seems to be, in crypto as well. And I think a lot more room for you to, increase your investments and make money, which is why I think people like it. Now, of course, all these factors that we just spoke about in the crypto market weigh heavily on the minds and exchange of developers. And therefore, building and maintaining them is quite an endeavor. So you want to make sure that you have a strong, adaptable development team. We are fortunate to have experienced developers that have worked at CME and for Citibank in New York City. So that's great. Our company also has a very much product first mindset. 35% of our revenue goes back into product development. We want to keep the product strong to keep customers happy. No downtime and no lag is our motto. And then, of course, we partner with local market makers to incentivize trading. The more professional tools that we have, the more we build, the more that will come to use the tools and hopefully, make their money. So there are three main components that our development team at Deepcoin focuses on to maintain and grow the exchange. So at the core, we've got the order matching system. This enables the speed and stability for the platform. Then, of course, we have the open APIs, which allowed us to scale and build upon that. And then last but not least, the user interface, which allows for adoption. But of course, we can't forget security. That's on top. Fortunately, we have never been hacked so far. Knock on wood. Our security team is consistently improving systems to keep our assets secure. All in all, our development team is about 80% of our total staff, and it's growing, I think, weekly at this point. Some of the bigger exchanges might have over 4,000 or so employees on the development teams, which shows how labor intensive this work is, but ultimately important. Then going back to that user interface. At the end of the day, of course, we need to build innovative and accessible trading tools for our customers to help boost their decision. We offer 125x on BTC and Ethereum and 75x on all of our other coins and tokens. In terms of leverage, we also offer 2 charts stacked with 26 complex indicators that you can customize and even draw lines on. We are also constantly developing our APIs to encourage calls. And of course, on orders, you can always place up to 50 take profit or stop loss points position. You can, do partial closing of orders and also set trailing stop on your merge orders. We've been working closely with investors to understand how they've leveraged our tools to improve investment outcomes for themselves. In our app, when you are going to place a trade, we break this interface into 3 parts: the account, the position, and the order. So the account piece is your available balance. Now this will play into the margin and your forced liquidation price. So it's important that you know your entry point or price. Then when setting the position options, a reduced leverage amount is generally better with smaller amounts. Strategize clearly whether to split or merge several positions. With Deepcoin, you can have up to 20 split positions at different leverages at one time. Pretty cool. Lastly, in the order section, you can capture that price point directly from the chart with our K-line quick trading. And we offer comprehensive take profit stop loss functionality at the time of the order or after it's been placed to reduce your risk of forced liquidation and allow you to reap more benefits, right? Great. Other tools our users like to use are setting alerts and using open APIs to engage in some algorithmic trading. Lastly, we offer the Deepcoin trial bonus, DTB, that allows for no risk trading on the app, and you can withdraw a portion of your earnings. Derivatives markets are important because their behavior influences the price dynamics of cryptocurrencies themselves. This is from Nicholas Kristen from the CLab Security and Privacy Institute. Basically, derivatives aren't going anywhere in crypto, and they're very important. And these exchanges that manage these derivatives markets are quite important as well. So now what's next for centralized exchanges? I think there will be more innovative investment products that we deliver. Next up, we've heard about some ETFs coming on the market and continued API development. Of course, NFT marketplace will continue to pop up. Different exchanges are releasing their own, to combat OpenSea. So we'll see how that develops. Of course, Metaverse and VR are hot, and more tokens in this arena will need to be launched and traded on exchanges. And generally, I think the trend around exchanges, they've been a bit more reactive in the past, but going forward, I expect them to be more proactive with setting trends, backing projects and helping to push new ideas in the blockchain space. There's launch pads, IEOs, ICOs, that all of these, exchanges are evaluating and helping push. And of course, Deepcoin, we also are launching a launch pad this year as well. And if you have any coins or projects that you would like to get in touch with us about, please find me or my colleague Russ, who will also be at the event tomorrow. We'd be happy to chat with you. So that's all for me today. Thank you guys, everybody. I hope you found this very informative. And I look forward to meeting you in person at the event tomorrow. Thank you so much.
Hey everyone, my name is Amitai. I will be talking with you today about the fall of Terra. So Terra, for whoever of you who have been living under a rock for the past few weeks, was a huge project, a huge fast-growing project that at its peak reached a market cap of $60 billion. It was number 10 by market cap in all the crypto industry. And basically, these past few weeks, it basically crashed in less than 2 days, wiping out almost all of its value. So this is definitely one of the crypto's biggest events and well worth looking into. I worked a year and a half ago on the white paper of the Levana protocol. I was part of the team that wrote it. So I have I'm pretty familiar with the Terra ecosystem, and I am excited to share with you my knowledge about it and talk to you about the crash. So like I said, my name is Amitai Ruskin. I'm a project manager and head analyst at Redefine. So Redefine is a startup that we're building an awesome product that basically allows investors or enables investors to analyze risk and mitigate the risks of investing in DeFi. So this is our company. Check us out on our website, redefine.net, and to get to know more. So what we'll talk about today. So we will look at a high level to sort of look into what a stablecoin is. We will talk a little bit about what the Terra ecosystem is. We'll talk about the main components that are essential for understanding how the crash happened. We will look into the timeline of how the crash basically happened, how it unwound, and we will talk about a bad actor that basically caused this crash to happen. In the end, we'll also look at some of the implications this event will have on the crypto industry in the years ahead of us. So, second. So I like to divide the stablecoins into three main buckets. The first bucket is fiat-backed stablecoins. It's pretty straightforward. You take $1, you lock it up in a bank account, you mint a stablecoin that represents that dollar and is redeemable at any point back to that dollar, and hence that's how it basically maintains its dollar worth of the stablecoin. This stablecoin works great, but it has one main disadvantage. That disadvantage is that it is centralized. Basically, these dollars sit at a bank that can be confiscated by a government. Another type of stablecoin is crypto-backed stablecoins. So what is a crypto-backed stablecoins? You take a certain amount of crypto, you lock it up into a smart contract, and you mint a stablecoin against that collateral. The collateral can vary between projects. Some projects are more on the safe side. They require up to 200, sometimes even more, % of the collateral to be locked up in order to mint a stablecoin against that collateral. So basically, this system is relatively secure. It's pretty tested. It went through a lot of events, but its main disadvantage is that it's very capital inefficient. It takes a lot of capital, a lot of Ethereum or Bitcoin or any other asset to lock up in order to mint a relatively small amount of a stablecoin. Another option, the one that's a little bit more relevant for what we're going to be talking about today, is algorithmic stablecoins. These basically don't require any collateral to be locked up. Instead, the peg is maintained by an algorithm. All right, we'll look into the USD's algorithm, but there are many different types of algorithms. These algorithmic stablecoins, their main advantage is that they are very capital efficient. You don't need any capital to lock up in order to mint them. But their main disadvantage is that they are susceptible to something called a death spiral, which we will talk about soon. So now that we understand what stablecoins are, let's look into the Terra ecosystem. All right. So what is Terra? So Terra is a blockchain similar to Ethereum, similar to Avalanche, and it has a native token called Luna, similar to Ethereum, AVAX to Avalanche. So this is Luna, but it also has something pretty novel, or had something pretty novel, called USD, which is a native stablecoin. Other stablecoins we talked about before, they run on top of a blockchain. What's called running on, they are an application to the blockchain. This, in the Terra ecosystem, USD is part of the core layer 1 blockchain. So these are the two of the main components. Another main component in the Terra ecosystem is the LFG. LFG is the Luna Foundation Guard. It's a nonprofit that its mandate was to maintain the peg of USD, the peg to $1. Another core component to understanding the crash of Terra is the Anchor protocol. Anchor protocol is a platform that was part of the Terra ecosystem, which basically allowed investors to lock up $1 worth of USD or more, of course, and benefit and basically get 20% APY, which is a pretty high APY, especially for it to be considered a very safe asset to be locking up. So let's look into how the algorithm of USD actually worked. So what basically happened was that a USD is supposed to be worth $1. If the USD demand for USD grew more than the supply, so basically price would rise and it would basically lose its peg upwards, be worth $1.01. So the algorithm basically encourages anyone to take $1's worth of Luna, burn that dollar, and after you burn the dollar, you can mint a stable coin worth $1.01, basically pocketing a cent a profit. And vice versa. If there was more supply than demand for the Terra stablecoin, then there was actors were encouraged to basically take a USD dollar worth 99 cents, burn it, and mint a Luna token worth $1, basically reducing supply and making it meet demand, bringing the price of USD back up to $1. So that's basically how the peg is supposed to work. Of course, it's unbelievably capital efficient. It works great until it doesn't. So let's talk about the death spiral. That's when things go south. That's how basically the Achilles heel of algorithmic stablecoins. So what is the death spiral? Well, for some reason or other, the stablecoin loses its value, goes down to 99 cents. And like we said, there's an incentive for actors to basically take that stablecoin, burn it, and mint a Luna token in exchange, basically reducing the supply of USD, which in theory is supposed to increase its price back to $1. But what basically happens is that a lot of other USD holders are seeing that the collateral that's backing their USD, which is essentially Luna, is going down in price since burning USDs creates more Luna, increasing the supply of Luna, which basically brings its price down. Then other people start to panic. They realize that they're holding an asset that's backed by another asset that's going down in value. They're basically, the collateral is going down. So they panic too. So instead of this burning the USD and minting Luna having an upward effect on USD, it has a downward effect as more people start to burn USD and start redeeming it. And basically there's a wide panic, basically a bank run, everybody trying to redeem their USD, which basically creates more downward pressure on Luna, which of course makes investors feel less secure about holding a stable coin. And this is a vicious cycle that usually goes Once it starts, it's very hard to stop. And most times it goes down to zero.
So now that we know what the death spiral is, the question we need to ask is, why did it happen now? The death spiral could have happened a few months ago, could have happened half a year ago. So why did this spiral happen now? Some of the main contributing factors for the death spiral happening recently was, first and foremost, the macro backdrop of risk off. Basically, interest rates are going up. A lot of assets are depreciating in value, and investors don't want risk anymore. They want to go. They have a flight to stable assets. This ties in with the next point, which was the unsustainable high yield that Anchor was offering investors. Anchor was offering a 20% APY, which everybody knew was unsustainable. They were funding this high APY with basically taking Luna, selling it, and then using that profits to basically incentivize more investors to pile into the Anchor protocol, creating price appreciation for Luna, and basically a vicious cycle where the appreciation of Luna was funding the APY. So everybody knew that wasn't sustainable. So basically, there was a lot of demand for the USD that wasn't coming from a sustainable source. Another very important contributor for the recent for the price fall was that the Luna Foundation Guard, led by Do Kwon, the cocky founder of Terra, he wanted to basically create a competitor to the 3 pool. So what is the 3 pool? The 3 pool is a pool where investors can swap assets. This pool is part of the Curve protocol, and the assets that are in this pool are DAI, USDT, and USDC. And Do Kwon famously had a lot of hate towards DAI. He famously said, "DAI will die." Of course, DAI is having the last laugh right now, and he wanted to create a competitor for this pool called the 4 pool, which would have the centralized tokens USDC and USDT. And instead of DAI, he wanted to replace it with UST and Frax, which is another algo stablecoin. So basically, in the preparation for the creation of the 4 pool, he pulled the LFG pulled a lot of liquidity off the USD 3 pool, leaving USD vulnerable with very little liquidity. The last point I want to talk about was that a lot of LFG's financial movements, they maybe show off, maybe as a sign of transparency, they announced ahead of time. So when they only accumulated around $1 billion worth of Bitcoin, they already announced that they're planning to get to $10 billion, which basically gave an actor a full understanding of the financial of what they were planning on doing. Another move that they announced ahead of time, they announced on the 1st of April the creation of the 4 pool, way ahead of it actually being created. So again, some bad actor will have an open book, knowing all the moves that the Terra ecosystem and LFG were planning on making. So now that we understand the contributing factors, let's look at the timeline and actually understand how the collapse happened. So I'm going to break. I wanted to break the collapse into 3 main phases. Phase number 1 is the beginning, where basically either some actor or many smaller investors started throwing a massive amount of USD tokens onto exchanges. The main exchanges were Binance and FTX, and the USD 3 pool we talked about before. In addition, also a lot of the liquidity in 3 pool and the USD 3 pool was pulled out, creating a price discrepancy, a very sharp price discrepancy, basically in breaking the peg for USD. In the beginning, the peg broke in a very, very small, you can barely see it on the graph here, but even this small break of the peg was enough to spook investors and create a mass panic of people offloading USD. So this all happened in May 7th and May 8th. In the end of May 8th, the LFG decides to respond. They start using $1 billion worth of the collateral that they bought. They bought also this collateral at $42,000, and they basically started offloading it at a market loss. And this loss also made investors realize that the collateral that they thought was backing USD is basically losing its value and being realized at a loss. So that also spooked them even more. And another thing that they didn't think that I don't think they thought of was that dumping more Bitcoin onto the market that was falling anyhow created even more market turmoil, especially in the crypto industry, which caused even more mayhem, even more insecurity of the market conditions. So after the LFG response, and basically this response backfires and it doesn't do anything to calm the market, then basically the turmoil continues. More people, more investors get spooked, keep throwing USD onto the market. At certain phase, there's something called the flipping, where the market cap of Luna, which is again the token that's backing the Terra stablecoin, flips, where the market cap of the USD surpasses the market cap of Luna, which basically this is not of actual significance since the problem existed before and existed afterwards, but this was some psychological barrier that once passed, investors got spooked even more, and they even more increased the flood to the gates, basically a bank run. So again, phase two, the Luna Foundation is trying all what they can to try to calm investors. They're tweeting all the time that help is coming. They're thinking of, they're searching for some sort of investor that's willing to be the lender of last resort and add liquidity into the market, but they're unsuccessful. Basically, the last phase, the phase of the actual turmoil, where the peg breaks completely, Luna gets wiped out. In the bottom, Luna goes underneath $1, basically falling from $60 at the recent height down to $1, a huge free fall. And you can see here, basically the Luna Foundation threw all the reserves at it. It did nothing to stabilize the markets. And basically at May 12th, the Luna Foundation had to halt the blockchain since Luna fell so much. It was susceptible to very easily for a attack because it wouldn't cost very much for an attacker to buy up enough Luna to attack the system. So let's talk about some bad actor. There's a lot of reports of this bad actor. As of today, there is no concrete proof. There is no on-chain proof for this actor, for there being such an actor. But even if there is or isn't exactly this attack or these moves, this makes total sense. And Luna was surely open for this type of strategy. So let's look at how a attacker could profit from or cause and profit from the depegging. So basically, the reports are that some attacker bought OTC over the counter, $100,000 Bitcoin worth approximately $4 billion, a huge war chest. He also, by these reports, bought $1 billion worth of USD stablecoin, and he basically bought up all the liquidity in the USD3 pool. At a certain, when the attacker decided to attack, he basically dropped all his BTC onto the market, creating a short position. He dropped all of his USD onto all the major exchanges and pulled out the liquidity from USD3 pool. So basically, how would attacker profit from this? Since probably attacker that has so many billions of dollars worth of capitalization, the Luna market wouldn't be liquid enough to facilitate such a move. But since Luna was decided its price was coupled with the Bitcoin price, basically that is already a liquid enough market for an attacker to basically put up such a massive short position and profit from it. By approximations, this attacker made away with $850 million worth. Again, what's very important to understand is that an attacker doesn't have to do much. He doesn't have to actually bring the USD price down from $1 down to 60 cents, 50 cents. But basically, all he has to do is manage to break the peg, move it underneath 98 cents, 97 cents, and the market already do that. The panic, the mass panic, the flood for the gates would already take care of the rest. So let's talk about some of the major outcomes that we can take from this event. So the first and foremost, the most important lesson we should all learn is that this time isn't different. People, algo stablecoins have been exploding. There are many, many cases of these experiments backfiring. And basically, the idea of basically using some sort of algorithm that allows projects to mint assets out of thin air is basically, it's a Ponzi, it's a hoax. It did not, this time isn't different. So it's important for you as investors, if in the future you hear of such a project that seems too good to be true, it probably won't stand the test of time. So that's the first point I think we should all take away from this event. Another point I think we should take away, or let's say a result from this event, is regulation. So even while the USD was happening, the crash was happening, already Janet Yellen already took advantage of the situation. They already talked about the importance of regulating crypto, regulating stablecoins. So this basically gave the regulators any proof they needed for basically investors, individual investors getting hurt. So we should expect harsh regulation as a result of this event. Another sad result for this event is crypto adoption. We all want crypto to become mainstream. We all believe that crypto has unbelievable tools that will benefit everyone. But when so many retail investors lose so much of their holdings as a result of the Terra crash, then basically it's probably in reality pushed crypto adoption a few years ahead of into the distant future, which is a very sad result of this event. Another very important thing to take away, this point is a little bit more technical, but there is Terra introduced basically a application, which was the stablecoin, into the base layer. And we, as a result of this event, we can see that this idea isn't a good idea. Basically, we should decouple layer 1 blockchains from the application layer above it. I'm saying this, for example, because a protocol, a blockchain called Near, saw the success of Terra, and they wanted to emulate this system. And I'm pretty sure that Near will think twice before actually doing it. So this is, I think, a very important key insight to take away. Lastly, I just want to talk about the importance of risk management. So basically, a lot of investors, they thought they were getting a 20% risk-free yield from the Terra Anchor, and in actuality, they basically risked their whole capital for a supposed sufficing yield. I think it's very important for investors before they ape into some project to do their due diligence, to analyze the risk, try to see how they can mitigate it, and basically be skeptical of things that sound too good to be true and unsustainable, very, very high APYs. So yeah, so these I think are very important key takeaways to take from this event. So thank you very much for listening. Again, you can feel free to follow us at Twitter. We bring out content related to risk, related to our product, very interesting information for investors to stay on top of their DeFi game. So thank you very much.
Eran Shay, businessman and president of the Gibraltar-Israel Chamber of Commerce. Good morning. We're joining us to the side chat of the ICC Israeli Crypto Community Conference here in Tel Aviv, but you're talking to us from Gibraltar.
Hi, good morning, everyone, from the famous Rock of Gibraltar. Yes, I'm based here in Gibraltar already for over 15 years, so already part of the Rock itself.
Okay, so let me introduce myself for a sec. I'm Nir Hirshman. I'm the head of the Israeli Crypto Blockchain and Web3 Companies Forum. We've sort of unionized the Israeli crypto arena, and now we're working on the Israeli regulation and helping firms and companies getting based in Israel. But I hear that crypto regulation, that Israeli regulation, has a lot to learn from the regulation in Gibraltar, actually.
Correct. When just to first give you a little bit more of introduction, the crypto regulations in Gibraltar began already in January 2018. Gibraltar was actually the first jurisdiction in the world to come out with a specific regulatory framework for crypto and distributed ledger technology companies. It implemented a specific regulatory framework for that. And since then, we saw a big influx of companies coming over to Gibraltar, be it as crypto exchanges, to do token issuance, OTC trading, and obviously more recently, NFT companies, distributed autonomous organization, DAOs. So yeah, there is definitely a big attraction in Gibraltar, which obviously I'll be able to explain a bit furthermore in a bit.
So what does Gibraltar has to offer to the Israeli entrepreneur?
Right, Gibraltar first, I must say, as I'm sure you heard the phrase, good things come in small packages. Gibraltar is one of the smallest countries in the world, actually the fourth smallest, only 34,000 people on an area of about 6 square kilometers. So almost the size of Ramat Aviv neighborhood in Tel Aviv. So that's small. Now, being so small, this is one of its main advantages, because being so small makes you more agile, makes you move fast. And for Israeli entrepreneurs, being not just in the crypto space, but we've seen companies in smart city solutions, green energy, software development, online gaming, fintech, you name it, a whole range from the entire spectrum of the high tech coming over to Gibraltar, because processes that take a long time in the big countries can be done here much quicker. There are much fewer bureaucratic hurdles. There is hardly any barriers to entry. There is hardly any competition, because Gibraltar doesn't have its own domestic high-tech sector. So they are always looking outside to bring innovative companies over, because they don't have the development resources domestically. And so a lot of the processes, especially on the regulatory side as well, can be done much quicker in Gibraltar than in the big countries. There is a very quick access to top decision makers, be it in government, in the regulator, and with private sector executives. And through the Gibraltar-Israel Chamber of Commerce, we've been able to assist a lot of Israeli companies in getting regulated in Gibraltar, obtaining their licenses, getting connected to some of the top corporates that sit here for their business development purposes. And from here, it's very easy then, once you have established in Gibraltar and kind of done your proof of concept, proof of product test trying in here, it's very easy from here then to leverage that success to the bigger markets in Europe, the UK, and beyond, of course, to the US and beyond. So it's a great place to test trying new technologies in a British type of standards and under EU type of regulations, yet with the ability to move quickly and without having to dedicate much financial or other resources to your setup here.
Yeah, so we've been hearing quite a few entrepreneurs that saying that the Israeli regulatory arena actually makes them to move abroad and to move to places that actually lets them cope with the basic functions that a company needs. One thing that we've heard, that banking problems, opening banking accounts, is a bit easier in Gibraltar.
Correct. I mean, in Gibraltar, we have an entire ecosystem here that supports crypto operations and distributed ledger technology, blockchain in general. We have banks here that are happy to accept crypto, convert it to fiat as well, and so you can have dual fiat and crypto accounts. And we have an entire network here of professional service providers, be it the lawyers, the accountants, the business advisors that are very savvy in the crypto world and can assist in whatever is required to move your business forward as quickly as possible.
Oddly enough, it's a bit saddening for me because, from our perspective, I would like those taxes to go to Israel, to go to the state of Israel, actually. And I think that one of the things that we've been talking to entrepreneurs, we've been talking to crypto firms, that the major difficulties that an entrepreneur, when he or she has to focus on hypergrowth and on the technology and on fixing all of those stuff that needs to be built and developed when you're actually working on a startup firm, the whole regulatory thing, the day-to-day, the bits and bytes of the regulation takes a whole lot of time. Even some say that it's about 50% of their time. And some say, well, we have to hop to somewhere that's a bit better. But then again, some might say, well, it's Gibraltar. It's not as accepted as Israel or Britain or UK or Germany or some states in the United States. Some say it can be a little bit murky or shady.
Well, I mean, Gibraltar is completely compliant with on EU directives on AML and KYC. It's true that if we go back to the, say, 1980s, 90s, Gibraltar was seen much more as an offshore type of tax haven in those days. But those days are long gone. Gibraltar, even since 2015, Gibraltar is on the white list of the EU and of the OECD. We have very strict KYC and AML procedures here, whether it is for the setup of your company, whether it is for bank accounts, for almost everything. Gibraltar is actually, being such a small jurisdiction, it meant that its regulator is able to monitor and ensure the enforcement of those regulations and making sure that everything is completely overboard. So everything here is completely kosher in that regard. And nevertheless, Gibraltar is still one of the most attractive jurisdictions in Europe, or perhaps even in the world, when it comes to taxation. It's true. Gibraltar corporate tax here is only 12.5%, and any income which is generated from outside Gibraltar is tax-free. So basically, many of the crypto trading companies, for example, or other businesses, if all their income is generated from outside Gibraltar, not from customers based here, which is, in a way, it's very easy because it's only a tiny place, and then they can actually generate their revenues that they are making. They can actually get it tax-free at the end here in Gibraltar. There is also no capital gains tax here in Gibraltar. There is no tax on dividends, no tax on investment income, no wealth tax, and no inheritance tax, and most important, no VAT. So it is still very attractive from a tax proposition, but on the other hand, it's completely whitelisted, completely kosher in that regard. Now,
I think that probably regulators from around the world are watching us now, and they're probably scratching their heads and they're saying, well, those guys, they're actually not taking anything. And we can see that there's a regulatory arbitrage that some companies are trying to take advantage of. But I think that one of the things that you show in a very eloquent way is that Gibraltar has its way to make the companies competitive. And if we're talking about a reality where companies are have problems with basic stuff as opening bank accounts, making bank transfers, paying their taxes. It seems that in Israel there's a problem for firms to pay their taxes. They want to pay tax, but they can't pay the taxes. I think that this is something that affects the Israeli companies' competitiveness and the Israeli crypto, blockchain, Bitcoin, Web3 industry less competitive. And for some extent, this problem can get even worse with you guys in Gibraltar gaining from it instead of the Israeli economy.
Well, for start, and believe me, I'm speaking as president of the Gibraltar-Israel Chamber of Commerce. Our aim here is to facilitate business between the two countries and promote business between the two countries.
But this is not actually business between the two countries.
Not that one side would take and the other side, would be left without anything. So what we are, and even within the Gibraltar regulation, the emphasis here is actually for the R&D operations to remain in Israel. We're not telling those companies, move everything over to Gibraltar. For the Gibraltar side, what they are normally require is to have your compliance officer here on the ground and at least, 2 working directors here on the ground as well. The rest of the operations can be done from Israel. And, we are not telling Israeli companies, oh, you should come here in order to avoid taxes. Completely on the contrary, we want to see the Israeli R&D continuing to develop. We want to see their businesses continuing to, flourish overseas, entering into a lot of the global markets. But in order to do it fast, and actually the richer that the company would be, the more that they would have to be able to pay in tax at the end, both in Israel and in Gibraltar. Because the more you sell, the more your R&D operations need to be strengthened and expanded. So at the end of the day, both countries benefit from it.
I think that the main message is that there are places in the world that actually compete for those firms, that actually say, well, we need to make those rules agile, quick, fast, highly adjustive for those companies to come and to flourish and to build. And I think that one of the things that we at the Israeli companies, crypto blockchain, Web3 forum has to look on is the way to try to approach the Israeli regulators and try to tell them, well, listen, the whole world competes on those Israeli firms. The whole world calls for those Israeli minds, those Israeli startups to come and develop or build their companies elsewhere. And we have to be more competitive. But would you be able to tell me what would you, if there's a list of do's and don'ts for the Israeli companies, for the Israeli Bitcoin crypto firms coming to Gibraltar, what things to do and what things to don't do?
Sure. So for a start, if you are looking to be regulated and licensed in Gibraltar, be it as a crypto trading company, be it as a crypto fund, be it as a virtual asset service provider in one way or another, it's important to know that and to understand that there is no kind of light touch in terms of what you need to do. It's not just, set up a company, fill in a couple of forms, and that's it. That's not the way the regulation works here. You need to have people on the ground here. You need to have proper establishment here. It's not the type of offshore type of kind of setup where you just have someone there acting as a corporate secretary or as a non-executive director, and that's it. You need to have proper people on the ground here to monitor that, to monitor your operations here, to liaise with the regulators. And one of the other things to know is that come to the regulator in completely honest and open about your intended operations. Don't come and tell them, oh, I'm just going to be doing, I don't know, dealing with 2-3 types of cryptocurrencies, where actually you're going to be launching your own token as well, setting up investment operations or asset management operations in crypto assets and things like that. Be completely open with them and direct about your complete plans, because if you start one thing and then tell them something else, this would completely require them to reevaluate everything from the start. There would be a lot of mistrust in that way, and it would just cause delay.
I think it's about the same. It's about the same everywhere. But those are very important points. Eran, Shay, thank you very much for having this conversation with us.
It's been a pleasure, and we are always welcome here to assist any Israeli companies looking to do business in Gibraltar.
So next conversation, physical and Gibraltar. This is an invitation, right?
Fantastic, of course. Come here, we'll show you the famous Rock of Gibraltar.
Thank you very much, Eran, Shay. Have a nice day.
Pleasure being here, yeah.
And that's a wrap. Oh.
Very well. Well, começa daqui.
Okay.
Hey everyone, my name is Rob Viglione. I am the CEO of Horizen Labs and also the co-founder of Horizen, the public blockchain, with a ticker symbol that's out there, tradable, called Zen. So I'm here to talk about innovation in crypto and why you should definitely join this industry. If you're an innovative person, a creative person, someone that just wants to get things done and potentially build the future that we think is going to come from this Web3 thing. So just a little background about myself, and then just to show you that if I can get into this industry, so can anyone, right? So my background, I actually started my career probably like many of you, since this is an Israeli conference. I started my career in the military, and I started my career in the Air Force, US Air Force, really on the science and technology side. I was a physicist, a mathematician, and then a junior officer doing those things in Air Force Space Command, which then lent itself nicely to ultimately as a higher ranked company grade officer, taking on a variety of software and research and development projects, basically having an R&D portfolio and working with a variety of scientists and engineers on super cutting edge, innovative things, right? But the military innovation cycle is a little bit different than the Web3 crypto innovation cycle. Pros and cons, right? Depending on what you're working on. And I can say, given the events over the last 20 years, the innovation cycle, even in the military, has been improving significantly. But from there, I branched out. I realized I had this base science background, but I wanted to then learn a little bit more about the world and maybe get a little bit better at making things happen. So I got an MBA, I went into consulting. I also spent a couple of years in Afghanistan doing a variety of things. But then I got this Bitcoin bug relatively early that afforded me the opportunity to, either choose between an Afghan commando unit or going back to academia. As a newly married guy, I figured academia was better for my lifestyle. So I did that. I went back for my PhD, and it was a PhD in finance, so financial economics. And I had a department back then that probably didn't quite know what this Bitcoin thing was. So when I asked them, can I study this thing, really for my dissertation, can I focus my PhD career on Bitcoin? They said yes. And they probably said yes because why not say yes to whatever a first year PhD student who probably doesn't know anything about anything anyway is going to ask. Say yes now, and maybe when they learn more, they'll pivot into something a little bit more interesting. Turned out that Bitcoin became pretty interesting. Bitcoin turned into a lot more than just Bitcoin. Bitcoin evolved itself as a marketplace into a variety of different technology offshoots, business offshoots, and different things to do with the technology. But really at the core of what it is a decentralizing technology. It's something that we call Web3, right? You had Web 1 being just simple networking, bringing people together and having things like news lists and simple websites. Then you add some more dynamic aspects to websites, and you have the proliferation of a variety of different Web 2 companies, things like social networks, and these things ended up consolidating, kind of a winner-take-all-ish or oligarchic type of market. And then we have this next wave we call Web3, which is all about decentralizing things. We'll figure out what those things are. We'll figure out what will lend itself particularly well to decentralization. And the truth is probably many things won't, but some things will be completely disrupted by this technology. The technology started from Bitcoin. It started with this idea of we can create a peer-to-peer network that is completely trustless. It has rules to the system. You could think of Bitcoin or a blockchain or this distributed ledger technology as a public database with rules, or a replicated database with rules for appending the information on the database. Basically a consensus. Like we have participants in the network, they're permissionless, anyone can join, anyone can run the software. By virtue of running the software, you participate in the network, and it works well. So Bitcoin brought some key innovations, basically patching some things that existed before, like proof of work for spam prevention with digital signatures, and just the ability to be able to broadcast information to the world, to a common public network. And we all agree on the rules of it. And if the rules are met, that information gets collected and added to a block, and that block appended to the ledger, and life is good. We can all agree on the state of all transactions that have ever happened if we all share the same rules and we all connect to the same network and we all can prove or basically reconstruct the same blockchain. This was big, and the first application for it itself was potentially like massive and disruptive, and that application was money. Bitcoin was, from the earliest proponents, and from some of those crazy enough, like I can count myself fortunate or silly enough to be part of that. We got into it for some reasons because we thought that this is a cool idea in the digital world to compete the idea of money and to make it digital, natively digital, rules-based, so that it's not arbitrary, where you have some, even if the rules might make sense, they're mutable. They can change, and they can change on the whims of kind of a very narrow group of people that make the rules. The idea of a global currency or a global money that's fixed in supply, like Bitcoin, that has very clear, transparent rules that no one can violate, all right, if you want to be part of that network, that was pretty appealing. And the idea that this network itself has its own evolutionary mechanism, again, pretty cool. So, but that in itself is, TBD, place that on a shelf of whether or not Bitcoin and these kind of like, fixed supply, hard currency, cryptocurrencies, what kind of impact they'll make in the world relative to the older world of fiat currencies. I think a big one. I think already it's fairly substantial, but the technology didn't stop there. The technology evolved when people realized, like Vitalik Buterin and the other co-founders of Ethereum realized, we could make a general purpose programming language here running on a virtual machine that compiles down to a blockchain, leverage the same technology for decentralization, but let's add a virtual machine on top of that. There, we can actually write a variety of different programs, and those programs can compile down to a blockchain. That blockchain is decentralized, and you have the state of the world, measured by active, decentralized, independent participants that all agree on the state. Again, super powerful, super revolutionary. And what these guys did was bring to the world now the idea of smart contracts. The industry evolved from there, and depending on who you're talking to, everyone will have their kind of taxonomy or ordered list of the most important innovations in crypto sense. Things that would be added to that list, we might debate the sequence or the priority in the list of big innovations. Things like stablecoins. So when people realize, hey, this decentralized digital money is pretty amazing, but it's ridiculously volatile. Merchants really can't be expected to use this at scale because merchants aren't foreign exchange traders. Merchants have a business. Their business has to pair their revenues with their expenses, their kind of supply chain. Their supply chain's not in Bitcoin, right? So what do you do to mitigate this exchange rate risk that when you're trying to convince people to use Bitcoin or other cryptocurrencies for payments? Well, the idea of stablecoins came about. Like we can still use the same underlying technology, and we can now issue things that actually look and feel, mimic the dollar, the euro, or pick your favorite currency. All right, so that opened a lot of new doors. The immutability, decentralization of Bitcoin, plus a smart contracting element of a virtual machine with Ethereum, plus stablecoins, and the baby that was born was DeFi, decentralized finance. The idea of writing customized smart contracts that actually mimic particular types of financial transactions that you would see in kind of the banking system or, a NASDAQ, New York Stock Exchange, capital market system. you could do that with smart contracts in an automated way on a decentralized ledger. Wow, that was the next innovation that happened. It was a really big one because it opened up a variety of doors that, when you're listening to this presentation, you might think that Rob guy's pretty crazy. Why should we care about DeFi when UST, one of the biggest stable coins that was part of this, nearly collapsed just recently? I could say did collapse. Their peg completely broken. Is DeFi dead? Absolutely not. The idea of being able to write a smart contract that does simple things like swapping digital assets on a smart contract in an automated way, that's here to stay. And that's important. And then a variety of other applications that are built adjacent to that leverage the same technology, things like automated lending pools, right? These are synthetic assets. So you can mimic assets, other assets in the world like gold, commodities, equity, like stocks that you would buy on the New York Stock Exchange or NASDAQ. You can actually mimic a synthetic asset with underlying crypto collateral. There's a variety of interesting innovations that happened in this industry in such a short order because it's permissionless and open to the world and very well capitalized because incentives are uniquely aligned in this marketplace. Things move fast in crypto. And maybe getting back to the main point of this discussion is this is one of the most innovative industries in the world, if not the most innovative, for a variety of reasons. And again, just to quickly recap, the fact that it's open to anyone in the world is permissionless. You don't have to ask me permission to build in the network that I've been part of. You don't have to ask anyone in the world you don't have to ask Vitalik to build on the Ethereum network. You don't have to ask anyone, Satoshi, to build on the Bitcoin network. These are open permissionless networks. Anyone can participate. There are direct financial incentives, in particular with the advent of tokenization on these platforms. So you can launch a DeFi protocol like an automated swap mechanism. That protocol has a token associated with it. Maybe that token's utility is for governance. By participating in the network, you can earn this other utility token. You can participate in the transaction fees that accrue on the network. And boom, you are directly incentivized for deploying this protocol and promoting it. There's a unique alignment in addition to the ability to earn revenues in new innovative ways, to basically raise capital in new and innovative ways. Again, big caveat there, legal disclaimer, depending on what jurisdiction you're in, you obviously have to talk to counsel on the different ways that you can raise capital in the Web3 world. But there are plenty of new ways out there to do so, including issuing tokens and new protocols that have tokens for utility. All that to say, you have some of the smartest minds in the world now coming into this marketplace. You have a wave of new innovation that is being extremely well capitalized and distributed because it's open to the entire world to participate, not just on the entry point, but also on the distribution angle. So things are moving fast in this marketplace. Now, my company, what I do, I can say we're one little example in this marketplace. You have everything from single developer entrepreneurs out there that are just deploying experimental smart contracts and code to extremely well capitalized companies out there like Horizen Labs, my company, or Consensus, or Animoca, Yuga Labs. You can name your favorite Web3 company, whether it's an NFT company, a DeFi company. Our company is something in between because we work across the NFT, DeFi, and deep R&D, cryptographic engineering space. There's a lot out there. I can tell you the way that we work through things. It was even the point of a company to exist in this marketplace when things are so innovative and moving so rapidly and you can raise money as an individual. What would you bother joining a company? What's the point of it, right? You even have examples in our marketplace, our industry, like Shapeshift was actually a company that disbanded. They were an actual company, I think based in Zug, Switzerland, and they literally disbanded, issued a token, distributed it to a variety of different stakeholders and made it available to the public. And all of the people that were formerly employees of Shapeshift are actually working now as members of this collective group managed by a decentralized autonomous organization, a DAO, right? So this is kind of weird stuff, guys, that probably 10 years ago, no one would have predicted other than science fiction writers, but it's here, it's happening, and it's moving really fast. So as a company, Horizen Labs, we're, you can say, trying to find ourselves or got lucky, found ourselves, stumbling along the way, but our vision for this industry, to paint a picture for the thesis that we have, take it for what it's worth, that grain of salt that, we've been around for a bit, but that doesn't mean we know what we're talking about very well. But I think we have a good hunch. I think the industry is going to go towards, on the cryptographic side, you could say provability. This is the idea of being able to cryptographically prove something so that you don't have to rely on any human being to be in the loop to validate anything. The industry started with Bitcoin, with Satoshi launching Bitcoin to the world as a completely decentralized protocol. The only thing that you have to trust or rely on is that the majority of the people that participate in the network abide by the rules of the network. Now, when that breaks down, and it can break down for different projects at different points, because not every project is as mature or distributed as Bitcoin. Most of the projects out there in the world right now, by the way, other L1s, layer ones I'm talking about, and L2s on top of the L1s, they break down in certain ways in that they're able to connect or scale, whether it's an L2 technology connected or a layer on top of a layer one, or whether it's like our type of technology we're built with side chains that could be equivalent or similar to, say, a Cosmos or a Polkadot. These technologies now deviate from the decentralization that Bitcoin brings to the table for the sake of scalability. And this deviation imposes an important trade-off in the marketplace that has some consequences. So like whenever you guys, if you're paying attention to the news, the crypto news out there, every week or two, you're going to hear about a different bridge system or technology or protocol that gets hacked, breaks down, and hundreds of millions of dollars are stolen. This is because these types of technologies that try to connect chains or connect different environments actually have points of failure in that they rely on certain parties to be trusted. This is a deviation for the sake of scalability in the industry that our company has spent years in research and development now to overcome, using a particular class of cryptography that actually is extremely well proliferated in Israel called zero-knowledge cryptography. Zero-knowledge cryptography allows you to do certain things like fully prove information and just, instead of having to replicate every single, say, transition or transaction on a network, to be able to just send a proof that all that stuff happened. You have a verifier on the other side that verifies the proof. By virtue of the circuit or the proving system that relates those two parts, you know that all of the rules that consensus on the network have been abided by. Not to go down that technical rabbit trail too much, but just to say that we're making a big bet on the future that provability and going back to full decentralization for security is going to matter a lot when this technology gets outside of the niche kind of DeFi and NFT space, right? So that's where we're putting a lot of our R&D and product dollars these days. But in the meantime, we're having a lot of fun in the NFT world. Horizen Labs was really the technology company working with Yuga Labs to launch ApeCoin. If you guys are familiar with that project with the Bored Ape Yacht Club, really proud of that work we've done with them on launching the coin or the token. And then also working, we did the land contract for the other side Metaverse. So, and we have a pipeline of other, of probably half of the 10 blue chip NFT projects out there work with us. So we have a fantastic business smart contracting group that just does really good work with those guys. We did that for a couple of reasons, because we want to be at the heart of Web3 and make sure that that's just always our culture. We want to be there. We don't want to be blindsided by the cool stuff that is going on because we're so focused on just the R&D. So we decided to just position ourselves there at the heart of Web3. It's a cool space. I recommend you guys, if you're interested in innovating in the space and exploring areas, you should check out things like some of the coolest NFT innovations or DeFi innovations. That's a good place to be. Our next big thing, guys, we're going to be launching an Ethereum virtual machine in the Horizen network, because the other big point for the innovators out there is we realized that over the years, while we were working on just this niche, like zero knowledge, interoperability technology, the industry evolved rapidly such that there's an Ethereum standard out there. That doesn't mean that everything is going to be built on Ethereum. In fact, Ethereum doesn't scale all that well. And that's reflected in the fee structure that's out there and the proliferation of other L1s and L2s to compete with it. I think that process is going to keep continuing. It is, even though Ethereum is upgrading its network with Ethereum 2.0, and we'll see how that goes on the scalability side. But I can say everything that's happening in crypto today is probably 1% of 1% or less of the types of transaction volume that could happen on this type of decentralized networking infrastructure. We're still operating in this early space of Web3 with DeFi and NFTs. We haven't really bridged out yet to solving some of the biggest problems in the real world, or making life better or things more efficient for major enterprises, governments, major use cases in the business sector, social use cases and so forth. We haven't done that yet at scale. We need to upgrade the infrastructure of our industry if this is going to be successful. There's a lot of opportunity for innovation in there. Now, we're kind of, as a company, Horizen Labs, getting back to the point of why do we exist as a company, because we have a lot of innovative people and smart, talented people in our company. And we work together. We work together on a variety of really important things. Those important things, again, upgrading the infrastructure, the building blocks of crypto, working with some of the hottest NFT brands in the world, building out an Ethereum standard in the Horizen ecosystem, and keeping our eyes on that future of a fully provable, decentralized, virtual machine world that we think is going to happen or has to happen for crypto to really take its rightful place out there as a meaningful technology in the world. So there's a lot to it, guys. I can say I taught a couple of classes of Bitcoin and blockchain tech at my old university when I was getting my degree. There were a lot of interested students back then. And even back then, I realized just from the interest that I saw from the students that are now, many of them working in this industry is really for the next generation. It's not for the old guys like me, even though we're having fun helping build it out. It's, probably for my daughter. It's probably for, her generation, or, the people entering university now that are just growing up in a digital world. They're going to grow up in a world where it just doesn't make sense to have, pieces of paper for currency. It just doesn't make sense to have to wait 3 days for a bank wire to settle. It doesn't make sense to have to pull some quarters out of your glove box to feed the parking meter. Everything is going to be digital, automated, and that's exactly where cryptocurrencies and blockchain technology works well. So it's probably one of the industries of the future, and I highly recommend rolling up your sleeves and diving in. So guys, thanks for listening to me, giving me the opportunity to talk here. Please feel free to reach out. I'm pretty accessible, whether that's on Twitter. You can go and bash some of the silly things I say, just LinkedIn, really just reach out, connect. Happy to talk to everyone, and especially if you come with some cool, interesting ideas. So thanks again, guys. I appreciate the opportunity.
Okay, hi guys. So we are here, Fireside Chat. With us, Mark from Fuse, Guy from Enigma, and myself, Erez from DcentraLab. Let's start with a short introduction.
Who starts?
Mark, let's start with you.
Cool. So everybody, I'm Mark Smargon from Fuse. We're building a network running since 2019, and our plan is to build an EVM chain that will bring vertical integration to the payments industry, and really focus on mainstream adoption and build like the most friendly blockchain for businesses and consumers. So that's really the how we started back in 2019. And sorry. Hello?
No worries. Yeah, we hear
you. Somebody called. Anyway, so that's me. We're based in Israel and working globally, almost 30 people, and really building an ecosystem, a local ecosystem here in Israel and a knowledge center.
Okay, thanks, Mark. Guy?
Hey, I'm Guy Zyskind, CEO of SCRT. We actually changed the name a while ago. Essentially, we are building SCRT.Network. I'm the founder of SCRT.Network. SCRT is one of the largest Cosmos chains today, which is one of the biggest ecosystems in crypto in Web3. Our focus is to build a blockchain that solves the problem of privacy in smart contracts. So anyone who's in the blockchain ecosystem knows that all blockchains are essentially public. Everything that happens on the blockchain stays on the blockchain forever and everyone can see it. We feel that this completely limits the ability to get blockchain to mainstream adoption. And so we developed a very unique technology that allows you to essentially encrypt all data on the blockchain and allow applications to basically process encrypted data without revealing it. This means that, for example, people there's a huge industry today around like NFTs and gaming. So if you take a very simple example, like doing something like a game on the blockchain. Let's take poker, for example, right? Poker, to be able to play poker, each participant should not be able to see the other participant's hands. And this is a very simple example that you simply cannot do on any blockchain today except on Secret. Again, just giving one example.
Okay, thanks, Guy, for the introduction. And about myself, I'm Erez Ben-Kiki. I'm a CEO, co-founder of DcentraLab. We started as a project named Tuki about 5 years ago, but since then we grew to be something a bit bigger. We are today a hub of 4 projects. One of them is Horde, which is a platform for creating baskets of tokens, ETF tokens many tokens under one token, launched on BNB chain at the moment. Tokens Farm, which is the biggest farm as a service platform. We are creating LP farms, vesting contracts, and staking contracts for different projects in the space. And our biggest project is Chainport. Chainport is a bridge. Right now, it's the 4th or 5th biggest bridge in the space. About 200 million TVL at the moment, and almost $1 billion volume to date, supporting more than 100 tokens and growing. Chainport right now supporting 7 different chains: Ethereum, BNB chain, Polygon, Phantom, Moonriver, and Fuse, Mark's network. And we are going to support more chains, more EVMs, and even non-EVMs very soon. We are big believers of what we call chain wars. The future of blockchains, in our opinion, is full interoperability, allowing people and projects and tokens to move freely between different chains from different reasons. And this is one of the biggest space that grows in DeFi in the last year. So this is us, DcentraLab, and you can check us on DcentraLab.com. So what brings us all together in here? 3 of us, beside the fact that we are friends and we know each other for many years, we are kind of veterans in the crypto space. I guess that since 2017, Mark and Guy even a few years earlier. So we are from the old times of crypto. And the second thing is that common to all 3 of us, we are all from Israel. So we are kind of representing the local ecosystem, which is one of the most unique and, in my opinion, one of the most interesting one in the world. Some of the earliest project in the world came from Israel, like Colorcoin and others. Vitalik visited Tel Aviv about a year before he established Ethereum, and he was very inspired. And we are seeing many projects coming from this space. So before diving into more about us or the Israeli ecosystem, it hasn't been a regular week in crypto space. So I think we cannot ignore it. And let's talk about what happened in the last week with Terra and Luna crash. Maybe Guy, you want to say something about it? Because I think you're the one most, I would say, affected or has the biggest opportunity with this situation.
Yeah, so for people who don't know, Secret was very close with the Terra ecosystem. Many people who were Terra holders, Luna holders, UST holders were also on Secret. There was a bridge between Secret and Terra, and a lot of applications essentially use each other's benefits. So there were applications using Secret on Terra. There were applications on Secret using UST and Luna. There are joint NFT communities. Our ecosystems and communities have been, let's say, combined and joined for quite a long time. So we've been very close to it. I think first and foremost, this is obviously was a really bad week for a lot of people, both retail investors and large holders who lost a lot of money. Some of them lost significant part of their savings. Even we were hit to an extent. We had the position. And truth be told, I've been in crypto for almost a decade, and I've seen Mt. Gox, and I've seen the DAO hack, and I've seen a lot of things. But I would be as humble as I can be and say that I did not see this coming, not by a long shot. No matter how many people are saying right now that in retrospect this was obvious. I mean, yes, you could point to, I think, specific things or let's say explanations why this could have happened, but anyone that I've talked to, myself included, could not have imagined that a $50 billion economy could be wiped
so fast. In days.
And for people who don't know, I expect everyone to know, but for people who don't know, what happened is there was Luna and UST. Both of these tokens are connected. No need to get into that. And both of them were wiped out. And both of them combined, UST was pegged to $1. That's what started kind of like the bank run when the peg was broken. And then people exited through Luna, completely decimating it. And at the end of the day, $50 billion economy was wiped in a week.
I think this is like part of the risks that building new economical infrastructures, and part of it is a big experiment. For people, it's much easier than ever to create new economical models, and some of them are not sustainable enough. But the way to find it is just when they are collapsing. So this was a very huge edge case. Like too many people or too much money went in and without understanding the risks. Maybe even no one could understand the risk. It could even grow for many more years and then crash suddenly. But as we all know, this is part of the risk that involved in crypto space. I think personally, I think this will also affect the whole crypto space. Like this was such a big collapse that it's not just pegged into the Terra Luna ecosystem. This is something that has huge waves that affects all of us in all aspects. But as kind of veteran in the space, I would say that I'm pretty sure the whole crypto space will recover from this. Eventually, there is only one direction for crypto in the last decade, and it's just growing. Mass adoption is coming, and those kind of waves, it's not something that will going to kill the industry. Just gonna make it a bit slow for a short period of time. Mark, maybe you have something to share about this? I think he has maybe internet issues. So for the moment, it's going to be myself and your guy.
So before, I guess Mark comes back. I think like crypto has already moved on for the most part. Like I think we're going to see secondary effects, but like I don't think it's a question whether crypto will survive. Like I'd say, I'm when we are recording this, like I'm at a conference right now. It has like hackathons, builders, and these are people that many of them were affected in one way or another. Like my second big surprise, other than a $50 billion economy collapsing, is how fast like everyone just came back to like normal business. And since the collapse last week, like we've been in calls like day in and day out with projects who are building on Terra, and they're like, no, we're moving forward, and now we're looking where else can we build, and many of them are coming to secret. But I think the point is that I'm actually also surprised to see that it seems that the space for the most part is unfazed about this. I think there are a few, I know of a few, let's say, large investors, like large entities that have been really, really hit from this, and like maybe even wiped out. But I think those are like the minority. Everyone else seems to have come back to business as usual, which is also amazing.
Actually, I saw a very interesting tweet yesterday that calculate that the biggest 1,000 addresses that hold UST, they hold about 96% of the whole ecosystem of UST.
Yeah.
So if the Terra project LFG, they want to compensate people back, they can just compensate 99% of the people.
It's 99 point,
something.
Guys,
we hear you.
So actually, I wanted to say I kind of just briefly, like when I look at this from the side, because I wasn't that involved in the Terra ecosystem, but as a sort of a competing L1 layer, we didn't really see competition because validating economic experiments, you don't need a blockchain for that. Like Terra theoretically could run on Ethereum. It wouldn't work, as a story. But also their ecosystem, I think, didn't really work. If you look at the usage that they have on Terra, it was a really it wasn't really a good idea to focus, in my opinion, only on the economic incentive part. It's the same problem Phantom has right now. Like you need to explain to people at the end of the day why you need the blockchain for what you're doing. The fact that on Terra you didn't have a DEX, most of Terra liquidity was scattered across a lot of blockchains, including on Fuse. A lot of problems. It was kind of premature experiment, but I'm absolutely positive that the mechanism of Terra is not something that will die. You know, I don't know if Terra specifically will be resuming operations. You know, go back to $1 peg, but I'm pretty sure that things like DAI and other algorithmic stable coins are here to stay. It just needs to be a part of an ecosystem. It can be like one feature and one kind of one product market fit, and I would say one critical mass of adoption, but not for the blockchain, only for the pegging mechanism. And I think it's not. It's probably a bit premature.
Mark, I'm sorry to jump in and with a lot of respect, I'm sorry to contradict you on a few things here. First of all, I think if Terra, like Luna, USD were running on Ethereum, this would have been so much worse. And that goes to the technicalities of how Ethereum work. Like I think one amazing thing that we saw here is how well the Cosmos, like Tendermint consensus protocol and the proof of stake mechanism there, how strongly and how well it works. On Ethereum, with the, I'm not going to go into a lot of technicalities, but in Ethereum, like you need multiple, beyond the fees that this would have created like a fee wall, and beyond the fact that, but mostly around the fact that it takes like multiple blocks to, to get like confirmation, like all of that with the UST Luna burning mechanism would have created a lot more congestion and would have created a lot more problems. And I think the effects would have been radically worse. So I think actually it's not true to say that they could have run on Ethereum. I think it was really good and useful. It wasn't enough because they were too big, but it was useful that they ran on a different blockchain with a different consensus protocol. That's one thing. The other thing is the Terra ecosystem wasn't just, I mean, the problem was that it wasn't just built on UST. The problem, it had like an amazing community, hundreds of projects. Again, we're taking in a lot of those projects into secret. Like they had a vibrant community and a lot of stuff. The problem was that Encore, with its like fixed like interest, very high fixed interest, overshadow and overtook everything. So like on every, like let's say one project that was building on Terra and bringing in, let's say $1 of liquidity, Encore got like, I don't know, $100 of liquidity. That imbalance is what really, I think, broke the system at the end of the day. But it's not true to say that that was the
but don't you think that putting most of Terra activity wasn't on the Terra blockchain? Let's look at liquidity. Let's look at the 3 pool, the 4 pool, the DEXs. Anybody use the DEX on Terra? They use DEXs elsewhere, and then they came with the dollars to Terra. I see a huge problem when a project worth $1 billion, but not really building any parts of the infrastructure. They're only building economic models. And economic models it's not an exact science. You need to test it at scale. Not saying Ethereum is amazing, Ethereum is great. I'm just saying they talked about the blockchain. I also saw the pitch of Terra, the white paper. They talked about a lot of stuff that has nothing to do with Encore and nothing to do with their current activity. They talked about Korean won. They talked about payments in the mainstream world. They didn't really, like, I see in the ecosystem that idea to do it, but the company didn't participate in building this. As far as I'm concerned, those billions of dollars went to create yield on other projects, on other networks, including on Fuse.
Okay, so we can talk about other blockchains for hours, but you raised a good point about not all blockchains, there is a really need for them. But I think that in this unique case of you two as a founders, there is a very unique case for the two blockchains that you've built. So let's talk about this for a second. Maybe Guy, let's start with you because you explained it before already, but maybe like in like 60 seconds, explains to people that are new to the space why there is a need for a secret network, why there is a need to hide information stored in smart contracts. People are sharing it.
I think at the end of the day, at least what I'm excited about, this whole Web3 movement is about building a better foundation for the internet. And if this is the new foundation for the internet, and this is eventually, maybe with the help of Fuse and others, going to be what we all actually interface with when we use our smartphones, our VR goggles, our laptops, or whatnot, then it's gonna have to have privacy. And the reason I'm saying this is that even think about all of the applications that you have on your phone today. Let's imagine that you use Uber, right? Like you would not use Uber if you would have known that everyone in the world could track your exact location at any moment in time. And that's the way Web3 and blockchain works today. Any application that you build on the blockchain, this isn't just about making sure that when I send money to you, no one else sees it. It's not about that. It's about the fact that any application that you build on the blockchain, at the end of the day, everyone would be able to see everything that you do. So if we come to a situation where actual financial contracts like employment agreements, like bank loans, like mortgages, all of that are actually facilitated on the blockchain. And there are good and bad reasons why you want and not want to do it, but I think there are more good reasons why you want to do it. Like, I would not want like people to know like what my salary is. You would not want people to know like how much you pay your employees and all that. All of those things today, they're public on the blockchain. And our philosophy is very simple. Blockchain today, despite all the noise, despite everything that it's making, it's this small. It's that small. And if you want to cross the chasm and get like the mainstream to adopt it, once they understand that all their personal data is there for everyone to see, they would simply not use it.
Okay, so now it's much more clear and we can understand. And I believe, crypto space is all about privacy. So your success will be the space success. Let's talk about Fuse. What's unique about Fuse versus other chains, and how you see the future of Fuse conquering its own niche in the space?
Yeah.
Mark.
So first of all, I agree with Guy that if you want to create the closest digital equivalent to cash, privacy is one of its features. One of the main features of cash is privacy, and I would not me, but like a lot of people claim that the fungibility of cash comes from its privacy, and in the future I see more people using blockchains to store money. And more people using blockchains for that property of being able to transact, and privacy is one of the features that we definitely need for this. But currently in the crypto space, I think we see a lot of projects that are trying to build like the fastest blockchain, a new consensus mechanism, like a new type. I think we're coming to a point where things start to consolidate, or at least we see it in the pipeline, but things are gonna get a lot more fragmented before it happens. So right now, in last year, 2021, we got a lot of basically multi-chain became a thing, and that's so we're in almost we can celebrate an anniversary soon for the multi-chain. First year of the multi-chain, and things are messy. And I think it's definitely going to be worse, like it's not going to be better. But what I like about crypto is there's no Pareto law, where it's at least it's not like super distinct, that you see like one winner and the rest of the market, this law that 80% of the profits go to 20% of the market players, or this idea that there's going to be one blockchain that will be the biggest. I think this idea doesn't work in crypto, and we see signs of that already. So we understand that building the fastest blockchain or trying to be like the world computer, those ideas are kind of stupid. Not all of human knowledge is going to be on one ledger, and nobody really thinks that, and nobody wants to really build that. But that's kind of how the pitch sounds for all those blockchains, and we're trying to do something different with Fuse. We're trying to balance not only speed but also comfort, good fiat ramps, good community, good ecosystem. We don't want to be, the most decentralized ecosystem, because we think somewhere between Visa and Ethereum, you have like a middle ground, and you need to create like an entry-level blockchain, kind of like a gated community, we call it. A different kind of product that really tries not to fork the user experience from Ethereum, but tries to really understand how consumers will interact with blockchains in the future. For instance, do we think people will pay for contracts directly? When they buy NFTs, they will need to hold Ethereum? Probably not. In the future, there will be much less friction. There will be reusable KYC, credit scores. Also thinking about our current models in the world are going to use blockchains to really change and improve. For instance, if we look at food delivery, Airbnb, Uber, all the sharing economy, app stores, all of those companies take 30% fee. Stripe, Square, Plate, PayPal all take 3% fee. There's a lot of business models that are really hurting digital economy, really hurting the sharing economy, and really don't let it grow, and really hurt competition. In North America, you have like 2 credit processing companies basically controlling the market. So you have cartels that are created, business models that don't work. If you look at P2P payments, B2B payments. So really what we see in Fuse is how can we build new types of usages, new types of business models. So I'll put a stop here.
Yeah. So thanks, Mark. And I would say just on top of that, maybe you can also be like the Israeli chain, because you are so close to the local ecosystem, and we are seeing like some blockchains around the world in some countries, they become like the local ecosystem chains. So maybe Fuse can be one like this.
Yeah. So I don't believe in local ecosystem chains. I do believe in geographical distribution. Because blockchains don't really know borders, but they really think that Israel is under, let's say, the ecosystem here kind of been losing in the last few years. It's not that big and not that strong, and we think we can improve it because everybody wants to go into crypto now. That's what I feel.
Okay, so just on that topic, before wrapping the call, maybe each one of us can share like what is biggest struggle building a Web3 company in Israel, and what is best tip to other entrepreneurs that wants to enter the space. Okay, I can start. So in Israel, we have a big problem with the local banking system. If people that hear this are not from Israel, Israel is run by kind of a banking cartel, I would say. We didn't have a new bank established in the last 48 years in this country. And the numbers of commercial banks in Israel is less than 10 only. So there's not really any competition between the local banks, and the local banks are really afraid from blockchain and crypto. So they are kind of blocking this whole space from growing, even though that local regulators, they really want this space to succeed and employ more people and eventually stream funds into the local economy. We're getting problems. So as any CEO, as any entrepreneur in the space in Israel, you will have to spend some of your time, usually a significant amount of your time, on just solving economical issues, running the company, unlike other places. But we are all very optimistic and we are all very positive, I would say. We think that those problems will be solved in the near future, and we are doing our best to solve them. And my best tip to any entrepreneur that wants to get into the space is don't think twice. Just get in. This is the future. Open finance, open ledgers. This is where the world is going to. This space is doubling its size year by year worldwide, and we are also seeing, I also seeing it with people looking for jobs when they're entering the space. They're going from the old world, from old advertising companies, from the TV companies, old databases, blue chip companies, and they want to get into Web3 because this is the future. And this is where I think you can build your next career for at least 1 or 2 decades ahead. What do you think, Guy? What's your best tip for anyone in Israel?
I'm gonna be self-serving.
Okay.
I'm gonna say 2 things. First of all, like I think it's becoming clearer and clearer, like especially people who are like, you know, coming from the military, from like the cyber units, like everyone used to win to go to like enterprise cybersecurity. Guys, that enterprise cybersecurity, like everyone's building like the same thing over and over again. The market is like oversaturated. You should come to crypto, don't think twice, ignore all the noise, ignore everything else. You're gonna have a lot more fun. It's gonna be a lot more interesting, and you're gonna be most likely a lot more successful on an average. So I 100% agree with you, just come and build. And the first tip would be, the first way to start is, if you know how to code, just come in, pick up a tutorial and build your first decentralized application, a very simple one. And then go ahead and build something that can actually become a business. And here I'm gonna be very self-serving and say that SCRT has a $400 million ecosystem fund to support people who are building on us. And we have a community of about, at this point, I'd say it's probably about 500,000 people, which is quite big in the blockchain ecosystem. So if you want like a large user base and a lot of like, you know, funding both from us and our investors, then ping me and let's talk.
Okay, thanks, Guy. Mark?
Yeah, so first of all, everything that Guy said relevant to Fuse as well. We want to build a knowledge center for smart contracts in Israel. We think that EVMs are not going to be replaced. They're going to be, you know, the HTTP of money. It's already kind of is the HTTP of money. Like if somebody wants to create a currency or do something with contracts, everything we see in the last few years, whether it's stable coins, DeFi, DAOs, NFTs, it all goes under the category of stuff you can do with contracts. And I think in Israel, we don't have a really strong ecosystem for solidity, for contracts in general. And we want to build that. So that's one thing that I think really is a big potential here. And then the other thing is, in the past, people would say better to ask permission than better to ask forgiveness than permission. That was like the Uber slogan to how you know, work in the market, how to bypass you know, regulatory hurdles and stuff like that. I think today it's not relevant anymore. It's totally gone mainstream. You know, companies are looking to find ways to get into crypto. We see, you know, artists get into this. Brands suddenly have something to do with crypto. So it really went in all directions in the last rally. And now there's maybe signs of a bear market, although I'm not really sure. And I think this is the big opportunity for entrepreneurs, because bear markets is when the serious people come in. It's where millionaires are being made. So it's really a good time to build. The timing couldn't be perfect, in my opinion.
I totally agree. This is the best time for people to build. This is the best time to focus, less noise, focus on what you're creating. And eventually, like the old saying, follow the money. Crypto is growing in space, the technology is growing, so it's a great time to join. Let's wrap up here. Thank you very much, Guy and Mark, for being with us, and myself, and thank you all, everyone, for listening. We are going to have a great event in Israel after a few years of Corona in a couple of days, so we will all meet in person, and let's keep building and growing the space and growing the local ecosystem. Have a great day.
Hi, my name is Todd Miller. I'm with Chromaway. We're the blockchain project behind Chromia, the layer 1 blockchain. I'll talk more about that momentarily, but it's great to be at the Israel Crypto Conference. Tel Aviv was one of my favorite cities, and excited to talk about property both in the real world and in the virtual world, or the metaverse as we're referring to it. I'm going to share my screen here. As I said, the title of the presentation today is about tokenized property in the real and in the play to earn metaverse worlds or virtual worlds. I want to compare to, we're quite involved in both types of efforts. And so I'll talk today about Chromia, about our blockchain and our project. I want to talk about a little bit about the basics of asset tokenization. And then I'll talk about the real and how they apply to the real and virtual property worlds, and what we can learn from both and how they can sort of cross-pollinate with each other. We'll talk about some solution use cases that we're doing at Chromaway, and then some summary and some lessons that I hope will be useful to other folks who are exploring this area. So first of all, about Chromaway, we've been around since 2014, which is a long time in the blockchain world. Folks in Israel might be familiar with us because we were quite involved, our founders, in the Color Coin protocol, which was actually an early protocol to store other types of assets, non-currency or non-crypto assets in the Bitcoin blockchain. We're headquartered in Stockholm, Sweden. We have a development center in Kiev, although clearly temporarily relocated. I'm based in Washington, D.C., where we have a U.S. subsidiary, and we actually have offices and a presence in Tel Aviv and also in Utrecht in the Netherlands. We have about 150 employees, and we build open source technology rooted in relational databases. And I'll talk about the technology a little bit here. Chromia is our blockchain. It's our public chain. As we like to say, it's a relational blockchain because it's rooted in relational databases. We're very DApp oriented. We think we can host rich applications across many different industries using a proof of stake blockchain. The chain itself will be public, going to mainnet this fall. We have many projects running on it now as more of an L2, and we partner with other chains such as Ethereum and Binance Smart Chain around bringing applications to production today. The proof of stake chain is purpose-built. We built it ourselves. It's not a fork of another chain. The concepts around the apps are that they're hosted. Each app has its own blockchain, and those blockchains are then, of course, anchored with our Chromia chain, which acts as almost a directory chain, or that's one of the features of it. That allows users who are registered in one app through our vault or wallet to be able to access other apps through permission. We also offer public anchoring to a public blockchain like Ethereum or Bitcoin or another one. So we can add security without necessarily compromising on performance. I mentioned before the concept of a relational blockchain, and the nodes of our chain are actually PostgreSQL, or they could be PostgreSQL databases. We don't instrument those databases. The algorithm that synchronizes consensus utilizes those nodes to reach consensus, and then data is stored in those tables both as cryptographic links for the blockchain, cryptographic proofs, as well as raw data that can be indexed, queried, integrated into other databases for reporting and so forth. It's a very highly scalable solution, and quite excited about bringing this to market through Chromia. Okay, so we support many dApps across multiple industries. I'm going to talk about tokenization and smart contracts for real estate today, but we're very involved in DeFi, in both blockchain protocols for digital collectibles like NFTs, we call them originals, and then also supply chain and product provenance. As I said, we just have finished fairly recently a large project with the Inter-American Development Bank using this technology to record land records in Peru and Paraguay, something called LAC, or Latin America Caribbean Property Chain. It uses many of the protocols we're using in our games and other apps around supporting transactions that can then be recorded in the Peruvian property registry and so forth. This is a very exciting project, and you can actually learn more about it at Black Property Chain. We also are involved with the same underlying technology in play-to-earn games. Two games that are quite been quite successful and have a lot of notoriety in the industry. The first one is called My Neighbor Alice. The other one is called Mines of Delarnia. And I'll actually talk about My Neighbor Alice too, because we've had several land sales in that game, and it's been really illustrative about how we can use this technology, both in the virtual world as well as the real world. So first of all, I mean, for all these types of dApps, we're really at the end of the day creating some sort of a digital asset that has a cryptographic identity. We're storing it on a blockchain, and then we're trading it on exchanges in a decentralized way, either on exchanges that we build or other public exchanges. We use our primitives like our vault, which is a wallet, smart contracts, which are written in our relational language called REL, as well as we have other explorers and other tools that users can use in order to track these assets and make sure there's the transparency that's required. Yeah, so the question I wanted to ask today is how can we evaluate the use of blockchain for both real and virtual property? How can we learn from both, and what are we learning? So first of all, I know people are familiar with the fact that virtual land sales have grown, exponentially last year. I mean, certainly with the crypto market turned down, these numbers have fallen, but it's still pretty extraordinary. The market cap for virtual real estate, it was over sort of $4 billion. And that has grown to sort of 25% of the NFT or originals world. And you can see some really kind of eye-popping numbers here with regard to properties that have gone into DcentraLab, in Sandbox, in Axie Infinity and so forth. 2.5 million, hundreds of thousands of dollars these properties are going for. Now, just as a reminder, I mean, this is still sort of a drop in the bucket compared to real estate, which really the investable real estate is over some $9 trillion globally. So this is only a fraction, but it's a growing part of the real estate world, and we're learning a lot in the game world and the virtual world that we think can apply to actual real estate and things that we are doing right now at Chromoy. And again, if you look at the framework for both virtual and real estate, in the case of real estate, we're tokenizing an asset and imbuing it with rights, either economic rights or ownership rights or both. We're using a smart contract in both environments for transferring property, for establishing property. In the real world, we can we can use these smart contracts to program in compliance, which is important to comply and align with regulation. We're of course using a ledger to record the transactions in a transparent way, and leveraging exchanges, mostly in the virtual world right now, although in the real world, we can do peer-to-peer exchanges, because most governments, most regulatory regimes will allow peer-to-peer trading, which is also very popular among crypto traders. So that's an opportunity there in that way. Yeah, so if we kind of look at comparing the virtual and the real world of real estate, we have sort of different but also overlapping frameworks around investment. So a registry, of course, in the virtual world is a blockchain, that is the registry itself. In the actual world, it's a recorder of deeds or a property or land registry. In the virtual world, ownership is denoted by ownership of the NFT. Now, it should be mentioned here that today most blockchains will only support the smart contract and not the NFT itself, which could be the image or the other code around denoting ownership. That is one advantage that we're proud about with the Chromia chain, that because it is a relational chain and it can store more data, the image, the metadata, and so forth. We think that'll work better for games and other NFTs. Ownership, of course, in the real world is focused on ownership of a deed. Law in a game or virtual property is really designed through the smart contract, and it's internal to the game. So if the game publisher wants, or the folks that control the code want to change those rules, asset owners, even in the game or the virtual world, could be compromised. I mean, in law, it's usually the regulatory authority. So, and usually it's a security. And so property in the real world is, of course, governed by securities law. By the way, most of the projects around tokenization are working under exemptions to having to file as securities. And there's paths there that have worked very successfully and are working. Of course, value is a big question, because value in the virtual world has to do with the popularity of the game or the popularity of that property. It could be the location, for example, the Snoop Dogg property in Sandbox. Those adjacent properties have become very popular, but there's still a question about long-term underlying value. In the real world, long-term value is associated with location. It could be property enhancements and so forth. So these are still probably one of the most fundamental set of questions around how value can be ensured over a longer term in the virtual world. And again, I guess sort of diving in a little bit deeper on here, what is really tokenization of real estate? And it's the creation of a token that represents assets, an underlying asset on the blockchain. And so an issuer, whether it be a fund manager or a property operator in the real world, or a game developer or virtual land developer in the virtual world, is issuing some set of rights. In the actual world, those are mostly economic rights, not ownership rights. But in the virtual world, they typically are ownership rights given through the NFT. And those rights can be programmed straight into the token. And in the virtual world, we're allowed to more easily trade those token and trade those rights. In the actual world, we're still somewhat limited, but new regulation is coming online to allow us to do this in a much more easier way. And as I said, there are a number of peer-to-peer trading platforms which have become very popular in this area. Just an example here, let's talk about the virtual world of My Neighbor Alice. This is a game developed by our partner called Antler Interactive. This is a Swedish game studio that's built many successful games. And they built this blockchain game called My Neighbor Alice. And actually, I can give you a sense of this a little bit by playing it. And you'll get a sense of the virtual world which is being developed here. And this is a multiplayer game. And we had a property sale, third property sale this past fall. And the demand for that has been very high because of the scarcity of property. And more importantly, because of the emerging game monetary system, economic system in this game. So the number of participants that are in the game, the actions you'll be able to take, the quests you'll be able to do, there's a balanced economy here. We believe will sustain the underlying property value. I'll go back to presentation here. But you can see here that the example of a land sale in the virtual world, where there's 100,000 plots of total land across 6 islands. we had a third sale with just 100 plots for those were sold. 50% of the land is going to be used for rental and public facilities. So you would, the owner of the land would be able to rent out that land to be farmed and so forth, as I referenced, because the monetary system is so important to the sustainability of the land values. The cost per plot was 50 Alice. This is a token that's also traded on different exchanges. And interestingly, as an innovation that we are also looking at in the real world is around this sort of staking lottery. So instead of just auctioning off the land, which then tends to go to the highest bidder, but then can destabilize the economy, we used a lottery, and that lottery was implemented across several exchanges, as well as liquidity pools, and not an auction. So again, an example where we can learn something in the virtual world that can work in the real world. But what about in the real world? I mean, for tokenization of real estate, why would it be attractive? Well, most importantly, the real estate today is marked by great market inefficiencies and very little price transparency. And one of those elements is sort of legacy technologies. Real estate is a very slow adopter of technology. There's also a real interest among fund managers to bring in a new generation of investors, typically non-accredited, meaning these aren't wealthy investors. They could be millennials, but they want to get exposure to real estate. And so what we saw in Robinhood around equities, in the real estate industry, participants are really interested in seeing how can we introduce new young investors to real estate. And then the notion of, can we reduce the barriers to investment, which include very high offering minimums and lockup periods where you can't trade the real estate, and therefore it's not liquid. So can we introduce a secondary market? And those elements are working fairly well in the crypto world. Can we apply many of those to bring those into the real world of real estate? The way we're doing that a Chroma way, or one way, is that we're partnering with, for example, Blockhouse. This is a well-established Dutch-based fund management platform. It's an application that we were able to integrate on the back end to be able to, instead of issuing traditional share certificates, to issue tokens. And so Blockhouse has been working with large fund managers in Europe, and they provide the application to do investor onboarding, KYC, payment processing, any of the digital contracts and so forth, and any of all the investor management, including dividend payments and so forth. So we've invested with them to be able to offer this, to be able to do as a token issuance platform. So companies like Emo Tokens, this is a venture out of Belgium that wants to do fractional ownership of commercial and residential real estate, can use Blockhouse as a private label integration. They can offer their real estate on their private label platform, and we've integrated our Chromia protocol to the back end. Same with FundMe, another example of a marketplace for syndicated real estate. And again, on the back end, they can use the Chromia platform. And you can see that here, like for anyone who's used Chromia for games, you'll see the same, creating a new account on the platform. In this case, they're going to use a security token protocol to be able to, for those fund operators or real estate operators, to be able to issue tokens and so forth. So again, we're seeing here kind of same underlying platform, somewhat similar protocol, but sort of different, the virtual versus sort of an actual real estate world. So yeah, just to wrap up, what do we learn from this? What can we learn from both the experience to date around real and virtual property? Well, first of all, as I mentioned, we're using some of the same asset-backed token protocols in both environments, and we can learn about scalability and investor behavior in the game world and apply it to the real estate world. Also around sort of technical scaling and so forth. I think that to date, real property focuses generally on economic rights and not ownership. So we have seen some projects where NFTs are being issued for real estate. We think it's probably too early for that. Doesn't appear that there's a sort of a legal foundation for that. Directly owning the NFT does not really translate into owning the property because it's not recorded at a public registry. Still, it's a really interesting experiment, so we're watching that closely. Value in the real estate world is around location and maybe other amenities. But value in the virtual world, we're still trying to figure out. We think one area is if it's built around a working monetary system in a game, which will support those real estate values. Also, legality of the NFT. That's what's in a virtual world, but has that NFT been tested outside of the game environment? And with the game publisher, even if it's a DAO, if the rules change around recognizing that ownership, would the value of the NFT fall? In the real world, we're actually seeing a lot of really interesting things around ledger securities and governments passing regulation to allow, first of all, the blockchain is a acceptable registered for securities and for tokens. So we're excited about that. And then, just for the future, things we're seeing really interesting experiments around syndication, which has been a significant element of real estate around crowdfunding and the application of DAOs. And so we're excited about innovations like that. It's been great talking today. Look forward to engaging people at the summit more, at the conference more. I can be reached at Todd Miller at chromoy.com, and please reach out to me. Would love to talk to you more about real estate in both the actual, the real, and the virtual world, and the merging of the two. Thanks very much.
Hey guys, my name is Eitan Seri-Levy, and I'm here to talk about cross-chain liquidity and interoperability. So a brief history about blockchains. Bitcoin comes out in 2008 after one of the largest financial crashes in modern history. Then in around 2014, we see Ethereum launch, and in 2015, smart contracts come out. In 2018 and 2019, Cosmos and Polkadot launched, and these allow developers to start building their own blockchains. Then we see an explosion of EVM chains, BNB, Polygon, Avalanche, et cetera, L1s, L2s. And we see non-EVM chains popping up like Cardano and Solana. And fast forward to today, we have all these different blockchains. And now we have this issue of lack of connectivity between blockchains. So, blockchains on their own only know about what happens inside of their own ecosystem. So for example, in Ethereum, a smart contract can only fetch data within the Ethereum blockchain. There is no external way to provide data with just, the Ethereum blockchain alone. So there's no interoperability. And then again, for Ethereum, there's high gas costs. So for a lot of users, gas costs are prohibitively expensive. Blockchains like Bitcoin, for example, transactions can take up to 15 minutes. Understanding the UTXO model might be complicated for users. And there's also an issue with UX and UI. So, in a lot of ways, you have to be a native crypto person in order to understand how to use certain apps or how to move money from one place to the other. It's very complicated. And then, so we look at the multi-chain market share. So this is a graph that shows how much money is locked on all these different chains. So, you know, Ethereum obviously still has a huge chunk compared to the other chains, but as we see month by month, we see their share starting to go down from 67% in October 2021 to 54% in March. Obviously, this Terra, which is in the green, was at 10% in March. Today, not the case. But we see, you know, other layer 1 and layer 2s making great strides. Avalanche, Phantom, BSC is a big one, Polygon, and you know, there's a lot of reasons why they're doing well. I think one of the biggest ones is simply because it's cheaper to transact. And then, so we come to this thing called blockchain bridges. So bridges allow you to move money from one blockchain to another blockchain. And we'll talk a little bit later about how they work. But here is a graph showing the total value locked on bridges. So these are on the Ethereum side. So this is money locked on Ethereum, Polygon, Avalanche, all these different bridges, and this is in the billions. So we see April 2021, very little amount, relatively speaking, around $2 billion is locked up in bridges, where to fast forward to today, it's almost 5x. So obviously bridges are becoming more and more popular. Users are wanting to move their money from different chains. I know personally, I have money spread across like 3 or 4 different blockchains for various different reasons. So there's all these different types of bridges. We have like the Wrap BTC and Ren BTC bridges. Those are like bridges specific to a token. So they really only operate on one specific token: BTC, Wrapped BTC, BTC, Ren BTC. And then we have bridges that are specific to a chain. So like Polygon Plasma Bridge, the BNB Bridge, formerly known as the Binance Bridge. And so these are ways, these are bridges that are specific to a given blockchain. And then we have more generalized bridges that offer support across multiple blockchains for multiple assets, things like Chainport, AnySwap, Wormhole, etc. So, you know, we've been talking about all these different blockchains, you know, how much money is spread across this ecosystem. And so lately what people have been talking about is this thing called the multi-chain thesis. And so an important word to define right now is interoperability. So what is blockchain interoperability? Is the ability for different blockchains to exchange and leverage data between one another. And so this multi-chain thesis is built around this idea of interoperability. So again, we've seen the rise of a bunch of different blockchains over the last few years, and each one might offer something that the other doesn't. It might be faster, cheaper. Maybe it's really good for like NFT marketplaces, maybe for Web3 gaming. Maybe the user base just likes it. Maybe there's just money being funneled to it via grants, and projects just migrate to it because they're incentivized. So there's a lot of different reasons why a user might decide to use a specific blockchain. And we truly believe that the future is multi-chain, that, you know, though Ethereum and Bitcoin are great at what they do, there is a ton of opportunity and a ton of market share for these other blockchains to come in and provide utility for the marketplace. So what does interoperability look like? In its most basic form, you know, users want to be able to transfer digital assets between chains. I want to be able to send some ERC20 token from Ethereum to Polygon, or from Polygon to Phantom, etc. Or maybe I want to send my NFT from Solana back to Ethereum. Now, a lot of the bridges today, they do that. They allow users to send tokens from one chain to another. And so we're kind of like in this early stage of blockchain bridges, and there's a lot of work left to be done. So things like generalized cross-chain messaging. So not just tokens, but imagine interacting with smart contracts cross-chain in some generalized manner. Things like sending flash loans from one chain to another. So all these different ideas and that people are currently working on in the bridge space. And so, we're really in like this early stages of interoperability, and there's still a ton of work left to be done, improving user experience. And so things like, I've been in a lot of Discords lately, and people have been talking about cross-chain dApps. So these decentralized applications that don't just work on a specific chain, but work across multiple chains. So cross-chain liquidity pools, all these different ideas. And it'll really be interesting to see what interoperability looks like, 5 years from now. And so why is interoperability actually important? As we said, the number of blockchains has grown exponentially over the last few years. And as we also said, this idea of interoperability, communicating between blockchains, is still a work in progress. There's still a lot of work left to be done. And so we're kind of like this in sort of like R&D phase when it comes to interoperability. And also, as I showed earlier, there's a bunch of liquidity on all these different chains, and fragmented liquidity is actually bad for everyone. Instead of liquidity all in one place, it's fragmented across multiple chains. And so, users might experience slippage on a specific chain when trying to trade a specific token. And so, that's kind of bad, and it kind of holds back the potential for decentralized finance, and is just not great for users. So now we could talk quickly about how bridges work. Now, as we said earlier, there's different types of bridges, and they might have their different ways of sending and receiving messages to different blockchains. But today, most bridges, especially when it comes to transferring tokens, the way that they work is a user comes and deposits token on one side of the bridge on the source chain, and on the target chain, they're minted a wrapped version of that asset. Now, different blockchains handle that wrapped asset in different ways, but in general, that's kind of the basics. You deposit on one end and mint on the other. So there's always like this one-to-one connection between the native asset on the source chain and the wrapped asset on the target chain. And when the user wants to go back, they simply burn the asset on that target chain, and then the native asset is released to them on the source chain. And so, in general, that's how bridges work today. Obviously, there's a lot of work left to be done, and as I said earlier, we're just scratching the surface. So we really believe in the future of interoperability. We really believe in the multi-chain thesis. And so what we're really seeing today is what we like to call chain wars. All these blockchain bridge projects popping up, and some of them, as we said earlier, are specific to a specific token or a specific network. Some of them are more generalized, and they all are trying to compete for market share. So there is sort of like this war going on between all the different bridges. And so here's are some of the bridges in the space ranked by TVL, so total value locked. Chainport right now is at number 9. That's the bridge I work on. But we see all these different blockchain bridges. Some of them are token specific, example wrapped BTC. Some of them are a little more generalized, like Wormhole and Chainport. And so, yeah, we see this like huge competition going on, and this huge opportunity for these projects to capture large part of the market and provide real utility for users, because, you know, as we talked about earlier, users want to be able to move their money from chain to chain. They want to do it easily. They want to do it quickly. They want it to be cheap. They want it to be safe. So yeah, it'll be interesting to see how the chain wars progress over the next couple of years, but it's definitely exciting times. So now, just to give a quick brief overview of Chainport, we're a blockchain bridge. We provide custodial level security, and we provide real interoperability. So what does all that mean? So blockchain bridge, obviously you can move money from one chain to another. We support 7 chains so far. We're currently working on supporting Cardano, which is our first non-EVM chain that we're going to support. And we're constantly adding new chains. And what does custodial level security mean? So what that means is that we keep deposited funds safe. So as we said earlier, with how bridges work, when you deposit it on the source chain, you get minted on the target chain. Well, that money that sits there deposited on the source chain, it sits there for a while. And a lot of bridges today, they keep those funds deposited on like a hot wallet or in a smart contract. And depending on if there are any bugs in the contract or somehow keys are leaked, those funds are put in a position where they can be stolen, or the contract can be exploited. And so Chainport tries to solve that by using custodial level security. So we store most of the deposited funds in cold storage using Fireblocks and Gnosis, using MPC security methods. And so, yeah, our whole goal with the bridge is not just to allow users to, port their money from chain to chain in a couple minutes, but also to keep that money secure. So, in a worst case scenario, users aren't left with nothing. And so currently we have around 180 million in TVL, almost 70,000 transactions to date, supporting 136 tokens currently, and doing average daily volume of around 2.5 million. And when we say real interoperability, what we mean is a user could come in with a token that we don't currently, quote unquote support, some ERC20 token, and just port it to a target chain without any input by us. So when we say full interoperability, we mean someone could just come in and port whatever ERC20 token they want, and they'll receive the wrapped version on the source chain in around 2 to 3 minutes. So that also kind of makes us unique in the space. And so, yeah, that's Chainport at a glance. So thank you for listening. As I said, my name is Eitan Levy, and I'll talk to you guys soon.